back to
and I
the
needed
show?
to correct it.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Healthcare, it feels like, has been discounted because what these drugs are going to do to the system. Again, it's going to do some good probably to the system long term, but not all med devices, not all healthcare companies in general will be hurt from this. There will be some that benefit from it.
That was Anna Mileti, the Allspring Global Management Head of Strategy, bullish on the healthcare sector, and healthcare likely to play a big part in today's jobs report, according to the team over at Bloomberg Economics. Chief US economist Anna Wong writing this: hiring likely was concentrated in only 2 sectors, Lisa, healthcare and government. We expect to see flat to marginal gains in other sectors, with outright declines in manufacturing, financial activities, and professional and business services. And this is the weakness, Lisa, people are talking about.
Especially because Ian Shepherdson, with 275,000, who's expecting that number, back out 40,000 from the strike, back out another 50,000, he said, from government hiring. And then in addition to that, all of the healthcare hiring. Can you say that that is a bullish sign for our economy when these are basically staples and necessary hiring that goes to something other than just growth?
And John, I'm so glad you brought up this quote from Anna Wong, because she's had a terrific 2023, particularly in the 8s. I mean, you know, going up to the high rates, and then boom, it turned on a dime. And that, you know, for someone like Anna Wong, that's what happens. You get the call right, and then boom, it changes just like that. Well, is today's jobs day going to be boom for people that look at labor economics?
I think the challenge for a lot of people, you can get the Fed call right, you've got the call on the economy dead wrong.
Yeah,
it's been a challenge for so many people, TK. So even if you called, let's say 550 on Fed funds, what was your call on the economy? People were talking about recession.
Exactly.
Q3, north of 5% GDP. Shocking to so many people.
Is this report at 8:30 that kind of boom statistic that upsets the apple cart on people trying to make 3 calls: rates, Fed, and jobs?
How much is healthcare hiring bullish? How much is that a bullish sign of the economic trajectory? That's one question that I have. I don't know. You know, honestly, this is sort of one of the things that people are backing out to understand the components when you break down this employment report.
On this jobs day, and this is so important, I'm going to give John Farrell major credit here for driving this forward. I'm like, yeah, whatever. I'm going to try to walk another mile. My physical trainer, fine training.
How's that going?
Ted Fine, killing it. He's got me doing this. He runs marathons. He wants me to run a marathon. I said, what? Down to Dwayne Reed. Anyways, it's there, it's front and center right now. We're going to digress here with Dr. Fazeli. Sam Fazeli joins us. Senior pharmaceutical analyst barely describes his competency on the moment, which is Ozempic and the rest of it as well. Sam, what's the future of all this weight loss, expensive drugs?
Well, hi, Tom. Thank you for the wonderful compliment, as always. The future, for one thing, talking about expensive, the future is going to be reduced prices. There's no doubt about it. There's going to be more competition. There's going to be more drugs on the market, and the prices for these drugs will continue to fall, even if you're not necessarily seeing them in what we call the list price, certainly in the net price that's coming down to payers. That's where I think you're going to continue to see pressure, and the volumes will keep going up.
Sam, you hold the mystery, or the answer to the mystery that we see every single month these times when we take a look at some of the inflation reads and the jobs reads. Whenever people don't understand it, they say, oh, healthcare costs increased a lot, or healthcare hiring increased a lot. What is going on, and how much is it reinflationary versus disinflationary, the way that we see costs in a lot of other sectors?
Yeah, so that's interesting with regards to the healthcare employment being a key driver in the read that's coming later today. Because I think if it is, then it's going to be focused in specific areas. Certainly on the corporate side, what we know from the very large biotech sector, that in October 2023 was responsible for about 800,000 jobs in the innovative drugs world, that's been losing people on an average 6,000 to 9,000 a month. And hiring has become much harder, harder for employees than employers. For each job, there's now 50, 100 applicants. So it's other areas of healthcare that I think are potentially driving this possible increase. And I have to say, it's probably likely because of the fact that we're still dealing with an aging population. That's not changed. And that's what's the basic demographic driver of healthcare and healthcare spending.
Healthcare costs are one of the biggest costs for a lot of households. We talk about the other components quite a lot. Gasoline, we talk about just sort of the food and basic goods that people buy. All of those things are going down in terms of price. And then we talk about healthcare costs. How much can this disinflation continue? How much are these efficiencies really likely before A, weight loss drugs really take effect, and B, in light of the fact that people are getting older and frankly, the age expectancy is going down, but not in a good way?
Yeah, I think part of that age life expectancy issue is because of what we went through with the pandemic, etc. And you know, there was a hiatus in treatment for many people, so that compounds the situation. But in terms of the future impact, you know, the sorts of drugs and therapies that really reduce the burden on the healthcare system, vaccination certainly one of them, but unfortunately that's going in the wrong direction in terms of attitudes. Drugs such as Lipitor, which are now generic and cheap, that reduce your risk of heart disease. Weight loss drugs, or weight loss in general. You don't need a drug to lose weight, but unfortunately, the impetus to do it and the exercise and diet is very tough, as we can see the evidence around us.
Yeah, but Sam,
as
doesn't it go beyond that?
Cheaper,
can it be about addiction and treating addiction?
I think those drugs in general seem to be addressing your increased appetite for things, right? So be it food, be it alcohol, be it smoking. Can they be proven to be actually that effective? Time will tell. But if they are, I think this could be something that will pay off in 10, 15 years' time.
Got it. Could be absolutely massive. Sam, thank you. Sam Fazeli there of Bloomberg Intelligence. Lisa, we've talked about this a million times over, I know. But the use case of these drugs, still trying to figure it out, as Sam indicated there. Still trying to work out, Tom, whether you can treat addiction in other spaces. Yeah. With what's been unveiled over the last couple of years.
You know, as people know, John and I are barely on speaking terms, but John, you've provided great leadership on this. I mean, look at the causes of Ozempic: nausea, vomiting, diarrhea, stomach pain, and constipation. It's the same as Tang. I mean, it's like the same side effects as Tang.
Okay, we don't need to.
Where's this thing going to be in a year? Is the money question.
No one knows.
Yeah, I agree.
It's always about a story, though. And the story at the moment, Tom, you just look at the statistics, and we've talked about them, Lisa, a million times.
Huge.
And I will
One of the biggest killers in the West, heart disease.
Can I see on TV or walking down the street people taking Ozempic?
Yes, sure.
Yeah.
But here's the thing. honestly, Sam Fazeli, who has studied pharmaceuticals and has a PhD in the matter, he came on and he said, people are tarring and feathering it, but it actually is incredibly effective and has been used for a long period of time and doesn't seem to have that many side effects. In diabetes, but there are these corollary effects to being obese that are significant, not to mention what John's talking about, which is addiction. And there are a number of studies coming out now that sort of suggest exactly that they can curb certain addictions. And this is another use case. It raises a question about how much we could potentially lower costs going forward. We were talking to Mark Rowan of Apollo, and he said people will find a way to kill themselves in other ways. But nonetheless, there is this thing about, how much can we really fortify our healthcare system?
Do you think that we stop eating and take on extreme sports? Is that how this works?
Are you looking at me?
Is that how this works, TK?
Pretty much.
Pull back on the booze and the
Increase the
fast
skydiving.
food and more skydiving.
Why are you looking at me?
I'm not saying anything. I'm not sure who's left listening after you've put them off.
No, I think people are riveted by this. John, you've nailed this. I mean, people are riveted by this debate over this, am I right, $9,000 a year drug?
As they should be, and we go over these statistics all the time, when you're talking about a nation, we're close to, what is it now, close to 40%?
Oh, yeah,
close
third
to
at
40%.
least. Yeah. Obese.
Yeah. Then this could revolutionize not just the lives of those people, but also the economy around them that we've built up over the last few decades.
To me,
you can see how this can be so big.
Am I wrong that there's like a whole free lunch to this thing? Is that like too Calvinist where I'm like, it's just too good to be true?
I don't think it's ever a free lunch, right?
Yeah.
You talked about those lovely side effects.
Nice.
But when you talk about how much we spend on dialysis every year, when you start to talk about the concept of kidney transplants in this country, when you start to talk about some of these corollary things, these are some of the things, that could.
Can you see her at Thanksgiving dinner?
I wasn't the one that mentioned side effects.
At the moment, I'd prefer Thanksgiving dinner with Bramo. You were talking about shooting up Ozempic on the streets.
No, can you see people on the streets? Can you, if you walk by someone, John, can you tell that they're taking Ozempic?
Yeah, dark alleyways, San Francisco.
I don't know.
Just shooting up Ozempic. That's how it works.
Stop. I think you meant in other ways.
I don't know why we're doing this on Payrolls Friday anyway.
Payrolls Friday. It's a digression.
Priya Misra, JP Morgan Asset Management, coming up
jobs.
shortly on this bond market on jobs and not on Ozempic. Equity futures negative 0.1% on the S&P, and the bond market yields look like this. Yields up higher, up by 3 basis points on a 10-year from New York City. This is Bloomberg.
The top names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Are going to see a slowing economy at the beginning of the year.
The real side of the economy, it does need to slow, in our view.
If rates are high for longer, which we expect, we will see some carnage.
We'll probably have a hard-ish landing. Not a hard landing, but hard-ish.
The path to a soft landing, to me, it always looked like slower economic growth. The hard part is sticking the landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Payrolls Friday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market pulling back just a touch after a decent day of gains yesterday. We're down this morning by 0.1%. The estimates look like this in our survey. TK, our survey says 183.
A big morning, and frankly, I'm more engaged than I was an hour ago. The last hour's conversation really shows how interesting the data is going to be. Not just wage dynamics or non-farm payrolls dynamics, but just back to coarse numbers. You're going to speak with the Department of Labor here in the 9 o'clock hour. They're going to go to the unemployment rate. What's it going to do?
Were you disengaged the previous hour?
No, I've been
just
into it for days.
Relatively speaking, more engaged. Okay.
No, but it made me ever more engaged in the 8:30 report because I think it's a huge mystery.
Keep it together, Lisa. The estimates look like this. 183 at the headline number. Unemployment, 3.9%. The drift towards 4%. And Lisa, maybe beyond.
So here's my question. Which component of this report is going to take the headline? It's always sort of like a roulette around, is it going to be the headline number that people are going to talk about? Is it going to be the pay rises? Is it going to be the average number of hours worked? Or is it going to be simply the headline unemployment rate, given the fact that it has been creeping higher? And if you engage with the SOM rule, with all the caveats, it has reached the point where you have to say that there is going to be some sort of recession.
We've had a big move in this bond market. Wisdom Tree, they think this rally in treasuries needs to be validated. They go on to say this, Tom, a resilient jobs report will continue to provide the Fed with cover as to not have to move prematurely in cutting interest rates.
Yeah, but our rates coming down not because of the Fed and the parlor game. Our rates coming down just because of gross nominal GDP and real GDP shrinkage. I looked at Atlanta GDP now solidly under 2%. This morning.
Honestly, I'm not sure that the Fed has any reason to hike rates further. The question now is just how big is the threshold to cut rates? And that's basically the message that we're hearing from everybody.
What's scarier, Priya Misra's going to join us. She's taking notes while we're talking, and I just looked over
definitely
and it
not.
says, Tom doesn't know what he's talking about,
They give that out to guess when they come on. It's just like a warning card.
It's a warning card.
Not Priya's. You get them when you make an appearance here, Tom. They give them out the back. Yeah. Let's get to the scores on the S&P 500. Equity futures pulling back by 0.1% on the S&P. Yields higher by 3 basis points. Lisa, the 10-year, let's call it 418.
All right, 8:30 a.m., 90 minutes time, we get that non-farm payrolls report. I'm personally watching the headline number. How much we get that 3.9% unemployment rate, maybe tick higher to 4%, or does it even just stay around 3.9% in order to dictate the next move maybe for the Federal Reserve today? We get reaction from the report. Jeff Rosenberg of BlackRock right after the report. And then in the 9 a.m. hour with John, we hear from Mohamed El-Arian as well as Acting Labor Secretary Julie Su. Very curious to hear the administration's take on a market that looks perfect. Can they keep celebrating this? I'm sure that they'll have actually a really great time just dancing around the numbers because it's a perfect kind of scenario for them. Am I wrong?
Isn't that what they always do?
Okay.
Dance around the
numbers.
numbers.
Yeah, but it's not working politically. I mean, let's not do Anne-Marie Hordern here.
Thanks for joining.
Come on, look at his poll numbers.
Yeah, they're terrible.
It's terrible. I just
agree.
The whole Bidenomics thing, I just don't get. It's not selling.
Well, you're not the only one.
Yeah.
Yeah.
Well, this is the reason why. We've seen sentiment decline, right? University of Michigan sentiment has come out, and it hasn't been as bad as some people expected. We still have continue to see it go lower. This is the key rate. We're going to hear from this at 10 a.m. How much people's expectations for inflation 5 to 10 years out continues to remain at the highest levels going back more than a decade. Is this part of what's underscoring some people's skepticism about the economic backdrop?
Lisa, thank you. Thanks for the promo for 9:32.
No, hold on.
It's going to work.
No. I actually
tune in as they dance around the jobs numbers.
Well, what do you think that they're going to say? What's the message?
I'm with you. I get it. I can't say what I think. Okay. You asked a good question though. How high or low is the bar for interest rate cuts from the Federal Reserve? Priya Misra of JP Morgan writes this. I think the Fed starts to cut later than March, but cuts 250 basis points in a soft landing scenario, 400 in a hard landing scenario. So there is more room for rates to fall from here. Priya, I'm pleased to say, is here and joins us now. Morning, Priya. Let's just start with that bar and let's talk about the thresholds to cut. How are you thinking about that in terms of where unemployment needs to be, where core PCE needs to be?
Sure. So I think the Fed raised rates because the economy was very strong and inflation was much higher than their target. The reason we're all talking about cuts is that inflation has come down. Now, I will say it's been only a few months. I mean, I think all the factors that were there to bring inflation down, they're still there. That pace of decline, though, the market's pricing in a very quick pace of decline. So I think what the market's saying is we have this immaculate disinflation. The economy is okay, but inflation's going to be at 2%, so the Fed can start to cut. I'm not so sure about the immaculate aspect of that or the disinflation continuing to 2%. The labor market is still strong. I'll be watching that average hourly earnings number very closely. If you get 0.3, year over year wages is running at 4%. How does the Fed look at that and say inflation is going to be at 2%? So I think the threshold to cut, to your question, John, is high. They'll want complete confidence that inflation is going back to 2%. We've had few years of much higher than that 2% number. But, recessions are non-linear. The economy doesn't necessarily respond that quickly to rate cuts. So I think once they start to cut, they'll be in a soft landing scenario. They'll want to take rates back to normal, neutral, 3%, let's say, 2.5% to 3%. But they'll start late, and that's when I think all those cuts will happen. In a hard landing, again, I think they start late. Unless the unemployment rate spikes a lot today, then they've got a lot more room to do because they have to take rates to accommodative, not to neutral territory.
You said two things there that are polar opposite potential outcomes. One is the immaculate aspect. You don't buy. You think that there is some sort of pain, or else you get inflation that is stickier. It's sort of those two poles right now that seem to be at play. Which seems more likely right now based on what you're seeing in the economic data?
So the economic data suggests cracks here, but not enough for me to say that the hard landing is right here. We should all be very humble about recessions. They never happen, right when you expect it. We're not exactly following any recession playbook. People have been looking for a recession for this year. I would say the data just suggests slowing down. But on the inflation front, I would argue that the data suggests it's slowing, but that trajectory down to 2%, that speed is what I struggle with. So I would say we're right now looking like a soft landing. Immaculate disinflation's been what's happening. But we have to be humble that the data can turn very quickly.
It seems like everyone is buying transitory without saying transitory, that essentially the disinflation that we're seeing is just a right sizing, that maybe the Fed had something to do with it, maybe not. Maybe we're just immune because they're going to cut rates back down to where they were before or close to it before they have any chance to really work their way into the system. Do you buy that? Is what we're seeing right now entirely sort of just the transitory aspect and not due to the Fed policy rate?
So I think that word has been banned from Fed speak, the transitory word. But I would say the supply side, which I hope the Fed brings it up. The supply side worked, right? From labor force participation going up, supply chains are much better. So goods inflation, that's why it's been declining. But I will say that there's components of demand. Look at housing, and that's going to continue. So I don't want to say that inflation is going to re-accelerate. From the housing sector, I think rent inflation is going to continue to decline slowly. What I struggle with a little bit is core services ex shelter. How quickly does that come down with a tight labor market? And that's what we'll be watching for today. That can start to get a little sticky on the way down. And if it gets stuck at 2.5, I think this Fed is telling us, no, our target is 2, not 2.5. That's why that threshold for them to cut rates is still higher than, I think, what the market's pricing.
Translate this to the real yield, the 10-year real yield, and I'm going to call it 2.00, 2.01 today. We've seen 199, 198 as well. But I don't think business people really understand the nonlinearities you can have in the inflation-adjusted yield. Are we going to get a rapid decline in the real yield here in 2024?
I think for the real yield to decline that much, you need to have the Fed starting to cut and the economy heading into a hard landing. So as much as I think real yields are what you should put in your Christmas list and buy some, especially if you own some risk assets, I think, you know, it'll only come down, like say below 1.5 when the Fed starts to respond. So they need to see that unemployment rate get closer to 4.5 or 5. That's when they're going to say, okay, this is not soft landing. This is looking like a hard
Scope and
landing.
scale that, because the real yield going up has been extraordinary here. Are you talking 150 real yield the end of next year?
Well, I think the economy is heading into a hard landing or a hard soft landing. It's kind of, you know, tricky what you even call this.
What is that? Tell me what that is, please. What is that?
You know, if the unemployment rate is at 5, is that a hard landing or a soft landing? I would argue it's a hard soft landing or a soft hard landing. But you know, this is tricky.
Do you want to go sit next to Bramwell? You know.
End of cycles are always hard. All the data is giving us mixed signals, and we're trying to, and the market's perfectly priced for a soft landing. So I think that's where it's going to stay volatile. The narrative.
She didn't answer my question.
Well, Priya, you've said this before, and Lisa has talked about this lots as well. When you start to see this conflicting, contradictory signals that we're getting right now, you're at a turning point. I just wonder what that means for the Federal Reserve next week. So let's play SCP roulette. You get the summary of economic projections. We know where they were. Talk to me about where they will be next week once we get these new forecasts from the Fed.
So I think their forecast for the unemployment rate will likely be higher, and their forecast for inflation will be lower. So the dot plot that the market really obsesses about had shown 50 basis points of cuts. I actually think it's going to show 75, maybe even 100. Now that's less than what the market's pricing in, but I think the market has to price in an economic outlook and a reaction function. I think the reaction function will sound a little hawkish, but the market can price in, you know, weaker growth. We have inflation before that as well.
24 dot, where is it?
I think it shows 3 cuts.
3 cuts.
From the Fed median.
Is that enough for the market, do you think, or is that pushback? How would you frame that?
I think it's enough for the market to keep those cuts in there. Depending on what happens today on payrolls as well as inflation, the market might reduce some of the cuts, I think, in 24, but put more cuts in 25. Because remember, the economy is also evolving. If we see the slowdown, and we should debate, does every cut of the Fed matter? I mean, the hikes didn't matter for quite some time. Will 75 of cuts really help the economy? So I think we should be ready to price in more cuts in 25.
Can you help us answer that? If the hikes didn't hurt, will the cuts help?
They help financial conditions. I think equities will love it. But then we have to look at the data and realize that it just might take a lot longer. The lags work both ways. So I think we're in for a volatile next few years for risk assets as well as the economy.
Priya, thank you. A soft hard landing or a hard soft landing? Did you get that, TK? Tom loves this stuff.
Get me going. I just think it's just parsing it too near. I'm very interested, though, in the ambiguity of where the real yield is going. To me, that's got a lot more reality.
If you are just tuning in, session lows, by the way, on the S&P 500. No real drama, though. We're down by 0.2% on the S&P 500. Yields up just a couple of basis points by 2 or 3 basis points this morning. 417.59. Priya, good news today? Bad news, bad news? How are you playing that game?
I think it's a little asymmetric, actually, meaning if you get a weak number, there's this nervousness in the market, and we're perfectly priced for immaculate disinflation, soft landing. If you get 100,000 on payrolls, I think the rate market's going to say, oh, the Fed's starting to cut right away.
Yeah.
Risk assets are going to say, whoa, that's not so great. This looks like a hard landing. So I think you'll get a bigger reaction with a weak number. I think a strong number is largely priced in.
And good news is kind of good news, right, at the moment, so long as you get these disinflationary trends. I'm with Priya on this, 100 sub 100. If I wanted fantastic entertainment at 8:31, that's the number I'd pick.
Sub 100?
I'm not saying that that's what I want. I'm just saying that that's the number I'd pick to say, you know, to see how the market would process that. I think you'd learn a lot. Let's see if it's like 90-something. What do you do with that? Do you start to get concerned about an economic downside?
What you do is you call David Kelly at this small bank in New York, J.P. Morgan, and you say, David Kelly, you nailed it. He's been calling for this trajectory for months and months and months to a negative non-farm payroll statistic.
To me, what Priya said there is lags work both ways. And the idea of will cuts matter, to me, is one of the biggest questions going forward.
Yeah.
What they will matter for is actually, to Tom's point, the movement of cash. Because at a certain point, people won't want to hold their money in money markets as much, and they'll put them elsewhere. Some really interesting dynamics heading into next year.
Obviously, what I'd really want is just forever cycles. Payrolls at 200K and everyone's happy. That's what I'd really like for Christmas.
Who is this? Where did we put John Farrow?
I'm going to enter Miss Universe. That would be my answer. What's your biggest wish? I'd be like 200K every single Friday of every first week of the month. And they'd be like, what are you talking about?
You'd be like, hi, elbow, wrist, wrist.
This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Eyes are on the U.S. job market.
We're moving in the way the Fed wants to see it.
Will the labour market hold up? Look to Friday.
Each one of these economic prints are going to have that much more heft and importance in markets.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The narrative is changing, and the facts are driving that.
How many people are off sides and need to get in and play now?
The November jobs report, today on Bloomberg Television and Radio.
Israel probably has a matter of weeks left to conduct these operations. Hamas knows this, and Hamas is using these humanitarian losses to build world opinion against Israel. And Hamas's survival rests within the concept of if there is enough pressure on Israel to stop operations, Hamas survives, the resistance has proven it's successful, and that itself could doom a two-state solution, if only because Hamas, which has survived, is committed to the eradication of Israel.
He has just been one of the absolute best on this topic over the last 2 months. Norman Rule there, the former senior U.S. intelligence official. From New York City this morning, welcome to the program and good morning. Your equity market on the S&P 500 looks a little something like this. Negative 0.2% near session lows after the bounce yesterday on the S&P 500 and on the NASDAQ. Absolutely flying. If you're talking about AI, great. AMD, Alphabet, what was it, Gemini yesterday?
Yep, Gemini.
Bramo getting everyone excited. Yields up this morning, 3 basis points, 417.78. Going into a jobs report just around the corner. If you are just joining us, I'll go through the numbers again just for your benefit. 183,000 is the estimate, Tom, in our survey.
Well, it's the estimate there. It's come down. Am I right? It's come down a little bit. It was 188, I think,
popped
earlier
up
in
to
the
about
week.
189. It's drifted back lower
coming,
again.
and then I said-
McKee tells me the whisper number is a little bit lower than that.
Yeah, and the screen, put it up right now on the screen, Amy, if you can. I know you guys are having donuts, but put up the screen here that's got all the different firms, non-farm payrolls. On radio, this distribution is, well, that's not what I wanted, but I'll go with that. You know, payrolls, there it is. Goldman Sachs, 238. Deutsche Bank, 130, John. There's a point of disagreement here.
Actually, looking at the whisper number now, Tom, it's ticked higher again, so we're about 200K.
I did
the
not
whisper
know that.
number,
Okay.
yeah.
We're learning by the minute here,
whisper.
1 hour away.
Never really understood that. People just type in their number on the Bloomberg terminal.
People give you a sense they inflected higher, but they don't want to put their firm's name behind
Okay,
it. So
got it.
that's
Because
kind
it
of
was
the idea.
lower. Yeah.
It's,
All right, cool.
moving target.
Good fun, guys. Thanks.
Joining us now, the whisperer of Washington, Anne-Marie Horton joins us, Bloomberg Washington correspondent. Here in the festive season at hand, Anne-Marie, I'm going to cut to the chase. There's nothing festive this weekend in the Eastern Mediterranean, really from the far north on down into a stressful Egypt as well. What will be Mr. Biden's approach this weekend to what we see in Gaza?
Well, today the president is heading off to Los Angeles. He's really ramping up on his fundraisers as he looks ahead to next year and the presidential election. But obviously, there's a tremendous amount of pressure on him and this administration when it comes to what we're seeing in Gaza. Just this morning, you heard from the director of the UN agency that works with Palestinian refugees, just talking about absolute wild streets in Gaza, civil order breaking down. And Norm Raoul was pointing to a lot of this earlier in your program about the effect and the humanitarian issues happening in southern Gaza. So this is going to become a big issue today for Secretary Blinken, because you have a number of Arab foreign ministers here in the United States, like Prince Faisal of Saudi Arabia, the Qatari foreign minister. They are here to talk about the situation in Gaza, and I imagine there's going to be a tremendous amount of pressure in those meetings with Secretary Blinken.
We are not hearing from the Secretary of Defense. I look at all the different newspapers, the ones you look at every day, and it's Blinken, 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 Blinken. What does the Secretary of Defense say?
Well, we heard from him last weekend, though, when he was speaking, and he talked about the fact that he wants to make sure that what Israel does is complying with international law, and he pretty much put a warning out there. Then you had Senator Lindsey Graham call him naive for this, because he said that we should not turn a strategic win into a strategic defeat. And he was talking about the center of Palestinian civilians and driving them into the arms of extremist groups. That was his warning. And, you're dealing with a situation now that has become incredibly difficult. If the Israelis are trying to go after, and they are, Hamas leaders in the south, well, the south of Gaza is where they told Palestinians in the north to flee. So on a humanitarian front, this is incredibly challenging, and the death toll continues to rise every single day.
How is it affecting the poll numbers for President Biden at this point? I mean, we know that it went down significantly, but has it evolved since then?
Well, I think there still needs to be more work done on this polling, because we have to see how this plays out. We do know that the president is suffering in the poll numbers when it comes to the youth vote, and obviously a lot of reports about Palestinian Americans, Muslim Americans, who do not like how this is being conducted from the Israeli side. We also had 5 Democrats yesterday come out and talk about the fact that they want to see more being done on aid, U.S. aid that's being sent to Israel, to make sure how that aid is being conducted, how those U.S. missiles are being used. So there's a tremendous amount of pressure on this administration. I think we've talked about it a lot in this program as well. Even within the administration, there's a lot of individuals, not in the top brass of the State Department, but a little bit on the lower level, who also don't agree with the U.S. policy.
I have to say, Anne-Marie, just to shift gears a little bit, I've been really fascinated by what can actually get done in the House in particular as we deal with some very real issues, whether it's some of the conflicts that you're talking about internally over aid to Israel, aid to Ukraine. We've talked about that, border security. Punchbowl came out, they're workshopping this one. They said that there is an infamous do-nothing Congress of the 1940s, and then they said, what do you call this year? Do-nothingist Congress, the less than nothing Congress, the zero Congress, the Congress that just is completely unworkable. Anne-Marie, is there any hope that that will change next year?
No, there's no hope that'll change. I think next year potentially gets worse. The numbers even get tighter for the Republicans on the House side. They ousted the representative from the New York's 3rd Congressional District, George Santos. Of course, we know the Speaker, Kevin McCarthy, is retiring at the end of this year. And they have a number of deadlines. The first, of course, being early in January for another potential government, leading up to a potential government shutdown. They're trying to get the supplemental package done. I really would, instead of looking at the House right now, because next week the House is also focused on trying to impeach President Biden or starting up that formal inquiry into that. Look at the Senate. That's where the deal is going to get struck when it comes to this supplemental package. And right now, all the tension is about border policy. Republicans want to see more, not just funds to the border, harder asylum process, stricter parole. Democrats want to make sure they're doing this in a compassionate way when it comes to individuals looking for asylum and refuge in the United States. This is where the fight is right now, and that deal will get struck in the Senate.
How alone is Senator McConnell?
Well, I don't know if he's very much alone. He's going to want to also see stricter border policy. I mean, this is also showing up in the polls. But he is a hawk when it comes to the defense policy. I mean, he's been talking about for months that we should be sending aid to Ukraine. The White House put out a statement this week from Shalanda Young talking about the fact that there is not a pot of money at the end of the year. It all dries up. And in that sense, his colleagues have not heeded his advice just yet. But there still is time. But, you know, a lot of people I talk to says this bleeds right into February.
AMH, thank you. Anne-Marie, down in Washington, D.C. Let's talk about December before we get to February. January, February in Washington is going to be ugly, by the way. The fighting over spending cuts, huge.
Yeah, you
massive.
had the 2 dates yesterday, January 19
nuts.
and 22.
And then into February as well, yeah. I want to go back to the whisper number just quickly. Update, 175, Bramo, 175. Been climbing all through the month of December, off the back of the data we've had this week as well.
I mean, just to show that early in December, they were talking about 150, and they've just been edging it higher. To me, it highlights how much people have been surprised by the continuing strength. We talk about bad news is bad news, good news is good news. So far, we've gotten good news, and it's actually been treated as good news. And I think that that's really what we would hear from some people who are proponents of just treat news as on face value. And trade accordingly.
Can you imagine if you tuned into this show on accident and listened to this?
No, I'm sorry. To anyone who has, I apologize. From every point of view.
About 10 minutes ago, 15 minutes ago, was talking about anything 100K or below would be treated as bad news for this market. And I think she's probably right.
100%, because if you back out 40,000 from the strikes and then you back out the government hires, all of a sudden, it's almost negative or almost no pay growth.
Do you know once I got the poll right? You know, they do like silly 8:30
People
polls.
don't do job guesses anymore.
Once I got it right, I've never done it since then. I figured it was such blind luck.
What year was that?
That was a million years ago. I think, you know, Nixon was president.
We used to do that. The whole newsroom would erupt.
They would erupt?
Yeah, when the number came out.
Oh, right, okay.
It would be a real dramatic moment.
Right. Exciting.
Yeah, yeah.
The acceptance of Purosang has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosang all over the world.
How much do you worry about increasing production and therefore becoming I guess, less high-end luxury.
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Sixty minutes away from the payrolls report. The scores look like this on the S&P 500. Pulling back just a touch, we're down 0.1% on the S&P. The Nasdaq with a decent bounce yesterday. Best day of the month so far on the Nasdaq 100. This morning, we're negative 0.25% TK on the Nasdaq. The beating heart of this market over the last month or so, the bond market, a rip-roaring rally. Yields lower, much, much lower. This morning, a touch higher by 2 or 3 basis points, 417.78 on a 2-year. What a turnaround, Lisa. Last time we played this game going into payrolls, yields near 5%. This morning, 462.46.
And the conversation used to be what the threshold was to raise rates again. Now the threshold is how far do they have to go? How quickly can they just cut rates extremely quickly? I mean, this to me is just sort of the way that the narrative has shifted. Everyone's just saying, how many cuts, not will they raise again?
And not just the Federal Reserve, the ECB as well. Let's look at that currency pair, the euro against the US dollar. The euro right now at 107.84.
No.
The ECB, according to most people, they're going to go first, Tom.
I don't buy it, but I agree.
They're going to go harder.
It's in the zeitgeist, no question about it. And somebody, was it Jeff Yu that had the call through parity?
Parity. Matt Hornback yesterday, Morgan Stanley. He's looking for a stronger US dollar.
We're distracted.
And maybe testing parity.
We're looking at Japan.
We'll keep talking over each other. It works. It's good.
It works. It's good.
You want me to get it on the game?
John, it's simple here. This is a big deal. This is a big deal on ECB.
I'm with you. 150 basis points to call it Deutsche Bank. And Lisa, largely priced now.
Yeah, although at a certain point you have to wonder how much pain they have to experience. We are seeing a bit of a stabilization, and will that be enough for them to cut as much as they are?
I think we've had enough of this market check, haven't we? Your top
brilliant.
stories today, under surveillance. An hour away from the November payrolls report. Bloomberg's median estimate calling for a gain of 183,000 jobs. Wall Street's biggest banks coming in with a wide range of forecasts. Lisa, Deutsche Bank at the low end, looking for 130. Goldman at the top end, looking for 238. We mentioned Ian Shepperson at Pantheon Macroeconomics, looking for, drumroll, 275.
Yeah, I think when you back it out, the question's going to be, how much is wage growth? That was what Priya was focused on. How much are we seeing the unemployment rate rise or stay stable? And I'm watching hours worked, because that also will give you a sense of just where people are starting to pair around the markets.
You got to pick up the CPI report next week. I took a look at the calendar next week, and you know, this is a big deal, and at 8:31, the world's going to change. But OMG, put it together with the data next week, including retail sales after the Fed meeting.
Yeah.
We're going to have a real snapshot of where we are.
Three-part act, tons of economic data.
Yeah.
The Federal Reserve next Wednesday. We're talking about cuts at the Fed, cuts at the ECB, and maybe hikes to the BOJ. Expected to end its era of negative rates this spring. More than 2/3 of economists polled by Bloomberg see the BOJ raising into positive territory in April. Traders and economists boosting their bets after a meeting between Governor Ueda and Japanese Prime Minister Kishida. The yen rallying the most in nearly a year before pulling back in yesterday's session. The next meeting, TK, for the BOJ, December 19.
Huge deal. And the other deal here is the culture of it. And Robert Feldman of Morgan Stanley in Tokyo, and the whole Morgan Stanley team is who I read first. There's others. Credit Suisse had a great team there before the blow up with UBS. But to me, it's also about Japan, the people, the demographics. And the fact is they're living 3% inflation, and that's undoable psychologically in Japan.
Yeah, 3 to them is like what here? Double digits.
My amateur take will be a solid 5%.
Crazy.
You know, crazy.
Amazing
No
to see.
question about that.
And amazing to see the guidance that we're getting from the BOJ, Bramo, where they start to say things like, it's going to get difficult towards the end of the year and the start of the year to conduct monetary policy.
Which is the reason why people are talking about abandoning it. The one complicating factor is that the economy is suddenly not doing that well. And there was data that came out overnight that the Japanese economy contracted in the third quarter at the fastest pace, going back to the depths of the pandemic. So it's sort of, are they going to be overcome by events in the opposite direction where they're not going to be able to move away? Because yes, you are getting inflation, but it's not being accompanied with the same growth that they're looking for.
Dolly Ann with a massive move in yesterday's session. Let's finish on this story. The US and the Palestinian Authority working together on a post-war plan for Gaza. The Palestinian Prime Minister telling Bloomberg the preferred outcome would be for Hamas to become a junior partner under the Palestine Liberation Organization and to build a new independent state, Tom, that includes the West Bank, Gaza and East Jerusalem. The Israeli Prime Minister Benjamin Netanyahu vowing to eliminate Hamas as the campaign expands in the south of Gaza.
I'm going to go to Mark Kimmett, General Kimmett, who has been a great font of wisdom for Bloomberg surveillance, and he talks about urban combat, hand-to-hand combat. It's a hand-to-hand combat weekend there. I don't care about all the punditry, all the diplomacy in that. Where are we in this war and battle Monday morning?
Ongoing
all that matters.
And increasingly difficult.
Yeah.
That's the story.
All that matters. An email in, Robert, thank you so much. This guy's emailed in from a goalie camp up in Toronto. Robert emails in, John, what do we do with this? Bearish joining Team Lisa.
Didn't most people join Team Lisa?
I think you're right.
It's a big team.
No one's on Team Tom.
It's a big team. And then they sort of ran away in November very quickly.
Is there a Team John?
What is Team John?
I don't know.
It's a lonely place.
Everybody's on Team Lisa.
We're just a pessimistic place. We sit around and just worry.
Yeah.
It's, it's a cultural
That sounds
thing.
like fun.
It's
Team Lisa.
literally family lore.
Yeah, Are you going to, we've got Sarah Wolf here.
We have.
With us, we're counting down to the jobs report, and she joins us. Team Sarah joins us with Team Ellen at Morgan Stanley. You people do hyper-accurate consumer economics. What's the state of 70% of the economy into this jobs report?
Consumer spending is slowing down. It's not falling off a cliff, but we're definitely seeing that down step in the pace of consumer spending going into the fourth quarter. We got an early read on holiday shopping, Black Friday. Sluggish, but as expected. We know that e-commerce was stronger, but you definitely had a consumer looking for discounting, more pressure for the lower middle income household. And we expect more of that slowdown to come next year as you get more of that pressure from higher interest rates, tighter lending standards, and a slowing labor market.
Buy now, pay later. Absolutely booming. What are you and the team saying about that?
Buy now, pay later is having a very large take-up rate, in particular for Gen Z, younger borrowers. The overall share of the credit market is still very small, so it's not as big of a macro problem. But I do think it's showing that, the demand for credit is slowing, the availability for credit is slowing, so households are having to lean more on BNPL, and this is more available to the lower income borrower.
Do we have space to lever up in households in America?
Households actually do have space to lever up. Debt service costs are still near record lows. They've barely moved up, in particular because 90% of household debt is locked in at a fixed rate, and we know nobody's buying and selling homes. So we're actually seeing that households are not super levered.
I just want to say this is the heart and soul of Zentner economics that Sarah Wolf's talking about here, John. Everybody's hysterical about consumer debt and all that, and I think we just heard we shouldn't be hysterical, right?
I would agree with that. I think that we're seeing pressure on the consumer, but interest rates are 5.5%. We've been in an aggressive hiking cycle. We should be seeing pressure on the consumer, but I don't think we need to go off and say that the consumer's falling off a cliff because we're seeing some rise in delinquencies and some pressure on the credit space.
We were hearing from Abila Faruqi, and we heard something similar from Priya Misra, that the longer things look pretty good and there aren't that many warning signs, the more likely a hard landing is. Do you agree with that?
Of course, the longer that rates are high, the more that these uncertain lags start to play out, and it makes the Fed's job harder and harder. Of course, they're in a really difficult position going into next year. Markets are pushing on for a March cut, but the inflation data is not going to feel comfortable enough for them to do so. So even as economic activity is slowing and the labor market's cooling, we think the inflation data is going to push them to stay on hold all till June.
Which is the reason why Torsten Slok of Apollo came out this morning and said the market is underestimating the Fed's commitment to 2% inflation. This is what we're hearing from guest after guest after guest. Where is the potential biggest market disruption? Where is the market most mispriced to what you and so many others say is the reality, which is the Fed is not going to cut rates aggressively come the first quarter of next year?
We think they're mispriced for March. Chair Powell is looking at the 3-month, the 6-month, the 12-month annualized pace. He specifically said the 6-month annualized pace of core PCE inflation is 2.5%. I mean, that's a lot of progress. But if you look at the path ahead in the next 3 months, core PCE 6-month annualized pace is actually going to be accelerating. And that's not till the second quarter that it starts to fall again. So we're going to start to get that data of core PCE picking back up again, and we think that could push out March pricing further out.
Well, picking up by 0.1%, or is it a demonstrable pickup that's going to upset our viewers and listeners?
Well, it's 2.5% right now. In the coming months, it's going to rise back above 3% because you have those negative airfare prints from early in the year falling out of the mix, and so that puts upward pressure. You have some upward pressure on car insurance. So we're going to need to get till April to get it back down to 2.5% again.
So, you know, I was just reading David Rosenberg, actually, Sarah, and this is exactly it. There are single items within the inflation report that are going to push up the mother of all Jerome Powell inflation statistics 0.5 percentage point. Airfare, car insurance.
We're going to have to look through the noise, but it's all going to matter. There's going to be a lot of focus on core services ex housing, a lot of focus on housing itself, which should continue to moderate. But you have to pay attention to the totality of what's going on in the inflation data, and it's going to be picking back up again in the coming months.
3-part story Wednesday. So statement, projections, news conference. Can you give us the guide for Wednesday?
Yeah, we're expecting very little change in the statement, but we are expecting for Powell to cautiously change his communication from how high to how long via the summary of economic projections and also through the press conference. What do I mean by that? Well, of course, they're going to be taking a dot down for this year, and we think they're going to show 75 basis points in cuts next year because inflation's looking better. They're going to have to mark down inflation to 3.5% this year, 20 basis points lower next year, so they're going to show a more dovish path, but he's going to have to keep pushing back that they're not yet talking about easing policy. He said it at Spelman last week. It's too early.
Except they are because it's in the 24 dot. Does the 24 dot compromise his communication in the news conference on Wednesday?
It's still above market pricing, 75 basis points in cuts, so it'd still be pushing back against the, 5 cuts that are priced in for markets right now, but it does make his job very difficult, where we've seen over 100 basis points in easing in financial conditions since the November meeting. Markets are really getting ahead of themselves, so he's going to have to be a little bit more explicit in his communication that it's too soon to be talking about cuts.
Which is the reason why I find it fascinating, the question, has the Fed already lost its credibility? Because he tried to push back, and the market just said, we're not having it.
The Fed's doing the best they can in a complicated environment, aren't we all?
So diplomatic. That's beautiful. Almost rehearsed, Sarah, that was. Do you like that, TK?
I was rehearsed.
Chairman Powell's doing the best he can, Bramo. Look, at some point, doesn't the market always test the Federal Reserve when it gets to this point?
They always test the Federal Reserve, and the Fed is trying to figure it out. But there's a lot of time between now and March, and there's even more time between now and June. As you said yourself, we have jobs, we have inflation, we have retail sales. I mean, we have a tremendous amount of data that could definitely move markets in the next week.
Mohammed Al-Arian thinks it's a communication problem, a credibility issue. We'll catch up with Mohammed,
need more speakers.
Mohammed in the next couple of hours. No, it's what they're saying and what isn't happening in markets. They're pushing back, but getting... Look, last Friday, the chairman got absolutely steamrolled. If that was pushback, Bramo, this market just laughed in his face and rallied really hard.
Well, I think that's exactly it. I mean, it was almost like a mockery because he was saying one thing and the market was like, oh, that's the best you got? Give me a break. You could have been so much harsher against the market move. The question is, do they care? Do they care that market conditions have eased? To me, that's a bigger question. If they don't care and he's not going to be that much harder in his communication, does that send a message in and of itself?
To put a number on that, and it's stunning, the Bloomberg Financial Conditions Index, the Goldman Sachs one's fine too, positive 0.56, and the answer is it's more accommodative, and the answer is they do care. It's plain and simple. It's moving away from the zero number substantially.
Sarah, thank you. It's good to see you.
Thanks for having me.
Hey, thanks for the guidebook for next week as well. Sarah Wolf there of Morgan Stanley. If you are just joining us, welcome to the program. Equity futures, negative 0.1%. Similar story in the FX market, a euro, negative 0.1%. In the bond market, yields higher by 3 basis points, 4.1816. And the most confusing story of the week, crude. Back in the 70s, Lisa up 2%, $70 at about 74 cents.
So the why behind this, I was reading, and I actually find this really interesting, even though they're incremental moves every day. But now the speculation is that Saudi Arabia, when they met with Vladimir Putin, who evidently is running for re-election again, I wonder who's going to win. But there's this question of whether he's cooperating more with Saudi Arabia.
Who is going to win?
I don't know.
Fascinating
Vladimir
stuff.
Putin
Can you bet on
versus
that?
who?
Can you bet on that?
Well, sure.
No,
I
probably
don't know.
not.
If you take us up, pick you up.
Where do you see the debate?
Probably not. Yeah, it would be a great debate. Any challenges, TK?
I steer clear. I'm not read in on it. I defer to Emery
That's
Horton
a very good way.
Henry Winter.
That's a very good way of getting around that. We talked about airfares. I want to talk about airlines. Earlier on this week, global airlines poised to generate record revenue this year and will extend the gains into 2024. The turnaround, Tom, for this industry.
Turnaround's there, but I wonder where the profit is. They're better managed as a generalization than they used to be. They're making profit, but you and I've noticed the stocks haven't responded. They're not to pandemic lows. They've come up a little bit, but are they booming? No.
We're off the highs of July.
Yeah.
Airfares, fuel costs, all of that part of this story. More still to come on that. Bloomberg's Brooks Sutherland on airlines and demand heading into the holiday season from New York. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Could face bigger challenges next.
Was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
I think this is probably the last time I'll talk about recovery, because we're effectively back to where we were in 2019. Always challenging with the general macroeconomic environment, but actually we remain cautiously optimistic about 2024. And I think the recovery we've seen in 2023 has been very encouraging and should give the industry reason for optimism next year.
That was the IATA Director General Willie Walsh. JetBlue also boosting its 23 outlook, citing better than expected bookings and operational performance this fall. The improved forecast coming after Delta's president signaled strong demand heading into the end of the year. JetBlue over the last 3 months, Tom, picking up just a little bit.
You think fuel's into it? I mean, you think,
Big part of it.
We have a panic here when the price of oil goes up and all that, but now the price is down. Does it really play in to the financial part of aviation?
I can only say the peak for discretionary stocks for many of them, including the airlines, Tom, was July, was early this summer. They struggled since.
I've had trouble with it. I mean, I look at the fares. I had to book a flight for one of the offspring here in the last 24 hours, and I was shocked how inexpensive it was. It was like, economy.
We're talking like 5K instead of 8?
No, this is like a local flight. It was like, 3, it used to be, it was $300 and then it was $700 and now it's like Middletown, not Teterboro.
Okay.
And then, the DeSalt. But the answer is it's gotten cheaper, even the short little junket flights. It's amazing. I mean, it's really, really.
Things have turned around a little bit.
Yeah.
I would still say it's expensive, but sure.
Let's do the math on this. We can do the math with Brooks Sullivan of Bloomberg Opinion, expert on aviation and all the moving parts of it. Brooke, I went to the source, Google Flights, and I looked at one of the international flights that John and I look at all the time, and it used to be $7,000, and I think I even remember a pandemic $9,000, and right now it's $2,000 $800 down from $5,300 median. This is New York to Paris. How did we get here? Why is that flight so cheap?
Well, you know, and actually the airline CEOs are trying to argue that the transatlantic travel season is going to extend well deep into the winter. And so that price data point is certainly not in line with the philosophy they've been espousing. But to your point, part of the problem is that airlines did not have enough capacity when we came back out of the pandemic. They got really stumbled by just the sheer volume of demand, and they didn't have enough people, they didn't have enough planes, and so they overcompensated. They added back a ton of capacity, and it's not like demand has fallen off a cliff for those transatlantic flights or for those domestic flights that your offspring were taking, but there's just a lot more available seats. And airlines are having to offer discounted tickets in order to be able to fill up those seats, which creates a very dangerous dynamic for their profit margins at a time when costs are also up, not just from fuel, but also from labor.
So forget about the PR from the aviation. Let's do the Brooks Sutherland guess here. What does later 2024 look like? Are they canceling plane orders? Are they taking capacity out? How do they respond to these realities?
I would be surprised to see them cancel plane orders just because the wait times for those aircraft are so long. And if you cancel it, you're really setting yourself back years. But I do think that we need to see substantial capacity cuts. Now, we've seen a little bit, specifically in the first quarter, but this is mostly really a trimming around the edges. We have yet to see this really big capacity cut that I think the industry really needs in order to be able to level set. But I do think, you know, that time is going to come because they're banking on a return in corporate travel that just has not materialized yet. We thought we were going to see it in the fall as more companies push people back into their offices. That did not end up playing out. If you don't have those corporate travelers, the airlines are very dependent on leisure markets where the capacity problem is really stark.
On the other hand, how much of a boom is it, some of these airlines, that gas prices have gone down as much as they have?
It definitely helps. I mean, fuel is one of the biggest costs for airlines outside of labor, and to see these prices coming down is definitely a boost, but I do think you have to wonder if you can bank on that. Fuel prices tend to be a volatile metric. I don't know if I would want to build my whole business around that.
There is this question also about the signal from airlines in the industry. We've been talking about how can you be calling for a recession when you have record demand, albeit maybe not as much as they were hoping for, but still incredible amounts of travel. Thanksgiving was booming, levels seen really that were at records, even including pre-pandemic times. Is it just a matter of expectations being even higher, or are we actually seeing some sort of softening in demand?
It's interesting because there was weakness over the summer on those domestic routes. And what the airlines said is that people were pivoting and that they were traveling internationally instead because those markets were much more open than they had been at any other point in the post-pandemic period. Now I think the pressure is really going to be on to see if people continue to take those international trips. I personally am skeptical. I think if you were a family, you went to Europe in 2022 or 2023, do you need to go back next summer? I don't think the answer is yes for a lot of these families. And I think we're going to start to see some pressure on the consumer when it comes to travel. We're already seeing it on big ticket items, things like lawnmowers, washing machines, motorcycles. I think that eventually extends to international travel and domestic travel.
Brooke, to your Kansas heritage, which is where aviation is centered. Sorry, folks, not the Carolinas. It's Kansas, Kansas, Kansas. What do you perceive as the future difference in engineering between Boeing and Airbus? Boeing is wicked traditional, wicked manual computers. Airbus is more fancy computers, fly-by-wire is what the adults like you call it. Where are they in 5 years? Do you feel like one of them will radically change, or are they set in their ways?
I think 5 years is a short time horizon. Both of them are trying to think about what the next generation technology looks like in terms of reducing carbon emissions from aircraft. Airbus is experimenting with interesting hydrogen technologies, whereas Boeing is really betting on sustainable aviation fuel, and they have a couple of other projects. So they are taking different paths, but the goal is really, how do we make these planes more fuel efficient? That is what is going to be the driver for the next generation of aircraft, because sort of incremental improvements from engine technologies is just really not going to get you there or be a motivator for these airlines. And so as Boeing and Airbus think about what their future pipeline looks like, that's really their priority.
So they're going to go down to one engine. I can see it now. Brooke, what?
Or maybe no pilots. I don't know.
Yeah, well, that's not funny. I mean, the idea here that we're down to 2 engines on a 777, I mean, where does the efficiency come from?
Well, I think I would argue that we're really pushing the efficiency limits of the engine technologies that we already have. When you look at the quote-unquote teething issues that these engines have had, whether it's the LEAP engine from CFM, the GTF from RTX, which has had particularly acute problems. Rolls-Royce has had issues of its own with its engines. I think we're really pushing the bounds of this technology in terms of what it can do. And so to really make a quantum leap forward in terms of fuel efficiency, carbon emissions, we're going to need some different technology. And what that looks like, I don't think the industry has actually settled on yet. They're pursuing a number of different paths and testing out different options.
Hey, Brooke, you're awesome. Love hearing from you. Brooke Sutherland there of Bloomberg. Thank you. Let's turn to the payrolls report. It is 36 minutes away. Neil Dutta of Renmark just publishing. Want to share with you just a couple of lines from Neil this morning. I continue to see some analysts noting that the threshold to cut rates is high because the Fed wants to be very sure about inflation slowing down before they ease policy. I don't get it. Goes on to say, the threshold is conditional on the inflation outlook, and the threshold for price moderation in the months ahead is not very high. For the likes of Neil, Tom, many others as well, the disinflation that's in the pipeline right now, it's already baked in. You're going to see it in the next few months.
As an almost inertial force, David Rosenberg seconds the motion with Neil Dutta this morning saying, look, this is the trend, get used to it. And what's fascinating, Jim Bianco was quite articulate on this in the last 24 hours, and he was way out front with the idea of leveling inflation, or even up, as we heard from Morgan Stanley and Sarah Wolf. That's sort of into the weekend, that's where the debate's engaged.
What I love about Neil Dutta is that he watches the show and listens to the consensus call and then writes in hate mail basically saying they're all wrong and this is the reason why they're wrong. They think that the threshold is higher than people expect. I think it's not. I think it's even lower. I love that. It creates the real dialogue.
Well, he's been right?
He has been right.
2024.
To be clear, we get a few more people that write in that say
I'm sure he feels right about 24 as well.
Right now, yes.
Can I ask a question? The wonderful conversation with
Please do, yeah.
Have you ever flown the ginormous Airbus plane? I've never.
Which one is that?
The A380, the one you're at Heathrow, and there's this thing next to you that's twice the size of a Boeing 747. Have you flown it?
I don't think so, no.
I've never flown it. I've flown a lot, and I've never flown it by chance.
Would you like to?
It's like twice the size of a Boeing 777.
Would you like to?
I don't know. I just
I'm
just like a dinosaur.
What we're talking about.
I think it's gorgeous engineering, as Brooke talked about. And
do you like it when there are 5 seats together in the middle?
No.
You think he sits in the cabin with 5 seats together in the middle?
Sorry, you're right. What
are you talking about?
Okay, all right, fine.
He doesn't even know what that looks like.
Okay. Like 3 and there's 5.
Payrolls 34 minutes away.
God.
TK hasn't turned right on a plane for about 50 years. Nadia Lovell of UBS is coming up next from New York City. This is Bloomberg.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but where it's painful for us to see the toll dementia has taken on her. So this is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We still have more and more evidence pointing in the direction of the labor market softening.
I think there is still some underlying strength in the labor market.
Job growth is strong. It has decelerated a bit.
Labor markets have been strong. It's going to be an interesting story when that reverses in the coming year.
You'll get a bigger reaction with a weak number. I think a strong number is largely priced in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on Jobs Day on radio, on television, across the nation, and worldwide. Where will we be at 8:31? Forget about 8:30. I'm interested in 8:31. In the market reaction here, the whisper number says maybe a little weaker than what the published numbers
You've set this up for the conversation you really don't like, so we're going to have the conversation you really don't like. The estimate in the survey is 183,000. What you're basically asking is bad news, bad news.
Here we go, please.
If it's 100K. I think that's going to be the really interesting thing, Tom. It's bad news, bad news. Is there a point at which this number comes in below estimates where people start to sit there and go, oh, that's bad, but it's really bad? Because not all rate cuts are created equally. That's the issue that I have at the moment.
Yep.
If they are the Neil Dutta surgical rate cuts off the back of the disinflation we're all expecting going into New Year, great, so long as growth is robust. But if you get that economic downturn, that's a different kind of rate
Swing it the other way. Ian Shepherdson, 250, 260, 270 goes the other way, John. I mean, I'm sorry. That's going to be a shock to the market as well.
Upside surprise, which tees up this one. Bramo, it's good news. Good news.
Well, I think that it depends which aspect of the news. As you guys were talking about the headline figure, I thought to myself, does it matter if the hours worked go down significantly? If what you're seeing in terms of the quits is it's going down? If the job openings is also coming down? If these other indicators are showing a softening at a pretty big pace? Can we get a read-through at a time where there's distortions from the UAW strike, from government hiring, from medical hiring, from other things that were already in the pipeline?
I don't want to take a lot of time here, but the difference in the two GDP measurements of GDP versus GDI, all you got to know is they don't match. What are the revisions going to look like? Do we have any idea of the veracity of the last two jobs reports, October and September? I don't think we do.
And then we've got CPI. And then you've got the Fed, and to your point, then you've got retail sales. I'll go back to something we talked about a month ago. So for the Neil Duttas of this world, this labour market is no longer a reason to be hawkish. And Lisa, what you and I have been talking about now for months, at what point does that tip and starts to become a reason to be bearish? Is it still too early? Based on what we're seeing in jobless claims, possibly it is still too early to expect that.
Especially if you believe in the Priya-Misra idea, which is that services-side inflation tends to be stickier, and that's going to be concerning. We also heard that from Torsten Slok over at Apollo, where he said people are underestimating the Fed's commitment to getting down to 2%, including that last leg, which is much more difficult.
Tough meeting for Chairman Powell, you know, next week. Really difficult.
And more difficult just in the last 2 weeks.
Yeah.
Yeah, with the market moving.
The market is pricing 100 basis point plus of cuts next year, and they've got to put in some dots for where they think rates are going to be in 24 and beyond. Tom, that's going to be difficult to do. 26
minutes away. We're going to do a longer data check here to set you up as we go into Nadia level and into the jobs report. John, the VIX 13.13. I think that says bull market, and a 16,000 NASDAQ 100 level. I think that says bull market.
Up 45% year to date after the move yesterday on the NASDAQ 100. That is just absolutely ridiculous. And more ridiculous when you think about what people were looking for at the start of the year. Tech's on its knees, and people are just kind of beating it up. It's not going to get any better. And then we absolutely ripped Bremo off the back of the AI story that dominated NVIDIA, and now Alphabet, and now AMD. Take your pick.
And nobody's willing to really push back heading into 2024.
You get
if you notice.
steamrolled.
Yeah, well, exactly. But what I find interesting is there's a change in rhetoric. It's not, oh, tech is going to lose value. It's tech might not outperform as much going into the later months when you start to get a broadening out in the market rally. Basically, don't bet against tech, and everyone is petrified of that. You can feel that in all the outlets.
That's stocks. Here's bonds. 2-year up 3 basis points, 463. 10-year Tom up 3, 418.
And where are we from 30 days ago? I mean, John, you and I were talking about it sometime, I think, when we had our 5:58 meeting to get ready for the show.
It's always a good meeting, yeah.
Yeah, it is. You know, you take a minute to get ready. And the answer is a 2-year yield from a 4.99 the day before the jobs report last time down to 4.62. I mean, this is the kind of scale.
Big turnaround. Does the data validate it?
Yeah.
We've seen those disinflationary trends. Does the data validate it?
We're going to do that with economics and with Michael McKee here coming up right now on this equity market. Nadia Lovell briefs always senior U.S. equity strategist at UBS Global Wealth. I think, Nadia, we're almost beyond the idea of, is this a bull market? I guess it is. Is it a bull market with breadth and widening breadth into 2024?
I mean, we think so, that, you know, the market breadth will continue to widen out. But we do think that some of the leaders from this year will continue to be leaders for next year. But again, a lot of this is just going to remain on the data. And to get this out of the way, you know we've sort of been in this market of rotating narrative. And it does feel like on the growth front, we're probably back into that, you know, too good news is bad news. Too much of a good news is bad news. And bad news is just bad news, just given how much rate cuts are priced into the market at this point. But this is temporary, and it could create some volatility. We think that ultimately, if the macro data continues to support a soft landing, that this market can move higher from here. And I think this past week we've had some interesting and encouraging commentary from many industry conferences, including tech, financials, and consumers. And companies aren't really seeing any slowdown right now. The consumer remains resilient. They continue to point to that. And so that should continue to support this market into 2024 and cause a burden out.
Let's pick out 2 sectors that I know you like, Nadia, and good morning to you. One is tech, the other is energy. Let's start with tech. The winners are 24. Are they the winners of 23?
Yes, we think that tech will continue to outperform, and that performance will broaden out. Obviously, we know that the AI enthusiasm still remains and is alive and well. We saw that yesterday. We continue to see adoption increase and also, monetization increase. And we know that there's still a leader in AI chip makers, but that's also broadening out, and the others aren't standing still. And we're also seeing others produce alternatives that really broaden out that field. But I will say that our view on tech isn't solely about AI. Yes, AI revenues are rapidly increasing, but on a relative basis, they're still relatively small in the overall sector. This is more about improving fundamentals in the rest of tech. You're starting to see cloud optimization come to an end. You're also starting to see, previously depressed end markets and semis improve and are at the cusp of a new growth cycle, particularly when you look at smartphones and PCs. So when we look into 2024, this is a sector that could see twice as much revenue and earnings growth as the broader market with margin expansions. And so that's why we think that at the core that tech can continue to outperform next year.
That's tech, let's do energy. So here's the struggle, and you know it. We dropped into the 60s on WTI this week, Nadia. I know that you and the team have been looking for 90 on Brent. What do you think is going on in the commodity market?
Look, it is totally understandable why the market lacks confidence in oil prices right now, just given the confusion around the OPEC Plus meeting last week, and the fact that the cuts into the incremental cuts into 2024 in the first quarter is voluntary. But given where oil prices are right now, we do think that likely increased the commitment from OPEC Plus, and you could see high compliance for that over 2 million barrels a day cut in the first quarter of next year. But of course, near-term volatility is going to remain just given the systematic selling that's going on. But we think that the demand picture remains intact. We're still looking for 1 million barrels a day growth in demand for next year, led by emerging markets. Oil demand products remain strong, particularly on the jet fuel standpoint. So some patience is required, but we still think that this market will be in deficit in the first half of the year, and we think that Brent oil can get back to $90.
Patience versus adding to the bet. Which is it when you look at Exxon shares that are down more than 17% since the end of September?
What we've been saying to clients who don't already have an overweight to energy, we said that this is an opportunity to add exposure because we think that these levels, that there's limited downside from here. We think that OPEC will continue to step in to support oil prices. Yes, we had expected last week to be a clearing event, but when you also look at these companies fundamentally are in great shape, strong balance sheet, do a lot of free cash flow generation, and returning that cash to shareholders through massive buybacks and dividends. And so we think that there is an opportunity here to add to energy for those who aren't already overweight.
I want to end where we began, where you basically came out and said that pretty much everything will be bad news that we get, even if it's good news, because if it's not Goldilocks with respect to the labor market report that we get in about 20 minutes' time. What does that mean in terms of how you are going to position on the heels of this? In other words, are you going to use it as an excuse to sell, or are you going to use it as an excuse to buy into strength that you expect at the end of next year?
We will be surprised to see, any weakness in the labor market near terms, just given how some of the other data are coming in. And the last three labor market reports have been encouraging for the market. But again, expectations are high given the number of rate cuts that are priced in for next year. And so if we see sort of, payrolls that remains in the high 100,000, to 200,000, we think that that is an opportunity to continue to remain in the market. If you start to see something, in the low 100,000s or below that, it does give a reason to pause and question whether there is continued resiliency in the labor market and what that means for the consumer. But ultimately, we think that the numbers will be fine. But this is a market that is on edge and will remain on edge and remain very much data dependent on what's going on in the macro.
Nadia, thank you for the update, and love catching up with you every Payrolls Friday. Nadia Lovell there of UBS Global Wealth Management. It's the second time we've heard that in the last hour. They're from Nadia Lovell of UBS, earlier from Priya Misra over at JP Morgan Asset Management. 100K or below, Tom, is the number that would spook this market.
It's a round number, and I'll agree with that, 110, 120. Who knows? Dan Ives publishing out on Twitter with a really smart note talking about stock selection and Nadia's call and blending in indexes and the strategy babble of, the bigger view. I would suggest 2024, typically in a bull market, 30% do well and 70%, it's like baseball, don't do all that well. And I think Dan Ives is onto something. The winners of AI, the winners in aerospace with Brooks Sutherland, it's going to be very selective.
You into baseball again?
I'm into baseball because the dreaded Yankees just made the trade of the year. I mean, it makes all.
Is Soto that good?
Oh yeah, he is the most patient batter in decades. The game is totally different when he steps into the plate. Totally different.
What would happen if they managed to convince Ohtani to come to New York as well?
The food sucks at Yankee Stadium, and I'd even go.
You know what? The food does suck at Yankee Stadium.
It does.
What is that about?
I don't know.
You know where it's good?
Where's
City
it good?
Field.
It's actually good at
Mets
City
is
Field.
way better. Yeah, no, it is.
It is.
No, it is. Mets is
You
way
get a
better.
soda, and then they put these chicken wings around the side of it. And I
Yeah,
see people
it's
dipping the
gross,
fried
yeah.
chicken in the soda. You seen that?
And then there are people who are selling Ozempic right next door.
Should be.
You know, what's amazing is at Tottenham, people are there with the little meat thingy.
Tom
with
takes a
fork.
knife and fork to eat the pies.
I heard about this. How'd that work out?
Unbelievable. Knife and fork to eat a pie at a football match.
I'm sorry.
Somebody yelled out, "Hey, idiot!"
You want to do that accent again?
Yeah.
No, all right.
Very, very British.
That wasn't meant to sound threatening. I'm sorry.
That's okay.
Thanks for joining us this morning. Futures lower, down 0.2%. That sounded so threatening. That was like, that was like a Guy Ritchie movie for a moment. I'm sorry, guys. So it just comes out sometimes. That football thuggery.
Did you see the goal yesterday where the Tots lost to Steve Major's West Ham?
I did. Kicked it against the post, got it back again. Yeah, I know.
No, but the defensive guy, here, I'll give it back to the goalie. And can we at least say he slipped on the grass? And I
think it's official now. You watch more football than I do. You watch more football than I do. I didn't even watch the game yesterday. I watched the highlights.
West Ham deserved to win. There was none of this VAR malarkey.
Wait, whoa. Did you actually watch the whole game, or did you also watch the highlights?
No, I watched the highlights.
Okay, so that's basically what.
No, you called me and you had the game on. What are you talking about? You watched the game.
Yesterday I watched a little. No, I watched a little bit.
No, all right, whatever. Jeff Rosenberg, 8:30 a.m. Eastern Time, responding to the jobs report just around the corner. Mike Data coming up very shortly of MKM. Very cool. The drumbeat to payrolls, about 17 minutes away.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
People are really focused on a couple of things in this report. Number one, how sturdy is payroll employment growth? You're going to get some benefit of the fact that the UAW auto worker strike in the U.S. is over and people are going back to work. And then the unemployment rate. The unemployment rate's drifted up this year despite the economy being very strong because labor force growth has picked up markedly. So those are the things that people are going to focus on. Now, 1 month doesn't make a trend. So obviously the market will react to the data that we get. But I think, the general story we have is economy that's slowing, inflation coming down, Fed pretty happy with how things are going.
That was the former New York Fed President Bill Dudley looking ahead to today's jobs report, saying the Fed is pretty happy with how things are going, with a pickup in growth in the labor force, rebalancing the labor force, TK, the supply side of the economy, doing better.
Yeah, where are we in the post-pandemic dynamic? And first of all, we've never been here. Back to 1921, someone had a research report saying this is not the roaring 20s. It's not 2021, 22, and all that. But what is it, John? Where are we coming out of the pandemic? And to me, the key thing is this study of productivity. That's a new thing in the last 90
Picking up,
days.
looking at that data. Mike
Yeah.
McKee can talk about that in a moment. I can tell you where we are right now. We are about 13 minutes away from that jobs report, and we look like this in the market. We're negative 0.2% on the S&P 500, and the number, TK, we're looking for is 183K in our survey.
To get strong over the next 45 minutes now and after the jobs report, as John Farrell mentions, Michael McKee will join us here. Jeff Rosenberg scheduled to be with us, but now we're thrilled to bring you Michael Darda, Chief Economist, Macro Strategist at Roth MKM. And Michael, this is perfect with the ambiguities that are out there. I was doing economic profanity yesterday on John Hicks and Slutsky of Moscow and the dynamics of the American economy. To me, it comes down to nominal GDP. You're expert. How quickly is our top line animal spirit imploding?
Thanks for having me on, Tom. Well, if you look at some of the tracking numbers for the fourth quarter, it looks like the expectations are running for just over 1% real GDP growth. And, with inflation, running down at 2-3%, you can do the math on that. And it looks like there's been a pretty dramatic slowdown in nominal or top line growth from Q3, which was booming, to Q4, which looks below trend. And so, we really don't know what the underlying trend is, but I think it's safe to say that it's a slowing trend. And this is what the Fed wants on the back of all the monetary tightening that they did last year and through part of this year. So the question is, do we just stop on a dime at trend growth and continue to enjoy this so-called immaculate disinflation and soft landing? Or, is it something more malignant that looks like a recession next year?
What kind of trend or single point signifies a slowdown? Lisa's talked a lot about 100,000 non-farm payrolls, but to you, is it 130, 100? Is it sub 100,000?
Yeah, I think it's, a little bit subjective. If the relationship between the ISM non-manufacturing survey employment index reverted to the pre-pandemic relationship with payrolls, we'd be getting about 75K in terms of payrolls. Now that's, way below the expectations of 185, 190. So that could be a bit of a shock. I think anything that's well over 200 probably injures the bond market, which has been in the throes of this big rally. So now we have 5 rate cuts baked in for next year. Tom, I'm a bit skeptical that we can have a soft landing, no recession, a double-digit earnings growth rate for the S&P 500 next year, and 5 Fed rate cuts. It would just seem that this is a little too good to be true in terms of the story that's been cooked up by many Wall Street strategists out there.
What do you think has to give?
Well, I think the business cycle is going to ultimately give here. One thing I'll be watching today is the unemployment rate. So the expectation is that we just sit there at 3.9. So we're up 0.5 from the lows of the cycle that we observed in January and in April. And it doesn't sound like much, but a 0.5 of a percentage point move is something you typically see right at the end of a business cycle or the beginning of a recession. It's not a decisive signal yet. I mean, I think on a 12-month basis, you want to see that 0.5% increase to be more confident. So we're not quite there yet. But if we continue to drift higher on the unemployment rate, to me that would suggest that we're potentially entering a recessionary period. So not quite there yet, but we're certainly moving in what appears to be a decisive upward direction on the unemployment rate.
It tees up the so-called SARM rule. Now, Michael, I just wonder, to get away from that just for a second, how rare is it to have moves like that in unemployment and we just stop there and don't go much higher?
It's happened one time, John, over a 6-month time frame, 0.5 without a recession in 1951. So that's the immaculate disinflation that has been priced into risk assets. But it's happened 0 times without a recession over a 9-month interval. And we were at 3.4 in January and in April. So over a 9-month interval, up 0.5 is unprecedented since the end of World War II. without the U.S. at a cycle peak or in the very early innings of recession. And keep in mind, these payroll figures that come from a separate survey can still be positive for a while into the early months of a recession. They're revised dramatically over time, as we all know. And GDP, the same thing. So the unemployment rate in terms of a coincident to slightly lagging indicator is probably the most robust singular variable in terms of whether we're in a growth phase or a recession phase.
One of the strangest aspects about this year has been that you could get the economic call right and the market call completely wrong, or vice versa. And when you talk about the potential for a weakening in the economic cycle, I have to ask, haven't we priced that in? I mean, if you take a look at the underperformance of the Russell 2000, if you take a look at the underperformance of so many stocks outside of the Magnificent Seven, aren't we prepared for weakness?
Yeah, that's actually a great point, Lisa. I think so. The small caps have really dramatically underperformed. Some of the cyclicals have really been struggling this year, energy, materials, and so the valuations there would suggest there's probably not massive downside from here. I'm a little worried about this idea of a value trap with some of the cyclicals if we do fall into an actual recession scenario. But when that's obvious, when it's a consensus view that we're in recession, that's going to be the time you want to start to be buying some of the cyclicals or the parts of the marketplace that have already been beaten up pretty badly. So that's an important point for investors to understand.
Mike, stick with us. We're going to catch up with you once the payrolls report is out. Before we drown in that, happy birthday, Mike. Michael Dada of Roth MKM. Don't we all want to look like that at 50? 50?
It's cut and chisel.
Just so cut and chisel, just, suave, we might say.
It's like Paradise City or something.
Yeah,
I'm looking at the Guns N' Roses poster behind him, and I'm thinking,
very good.
I'm just looking at all of the
Nice
songs. Yeah, I was
Nice.
Sweet Child of Mine, Don't Cry. These are the things in my head right now.
Very cool. News just in from Mike McKee. Breaking news. 185 is the new estimate in our survey, Mike McKee.
Yeah, can I just say I want to be 50 again? The croupier is saying place your bets right before they start spinning the roulette wheel, and we have moved up to 185. A couple more forecasts come in, and the whisper number has followed it up. We're now at 177. So it's interesting that not only do we have a higher number in terms of payroll change than perhaps Mike Darter was suggesting is justified, but Wall Street's going along with it.
Only you will know this. Is there a whisper revisions number? Maybe go back 2 months, right?
We go back 2 months, and we did see some significant downward revisions in the past, and you want to watch for that because Mike was just saying these things get revised a lot, and sometimes when you think there's a lot of strength, it disappears if we keep that trend.
How difficult is this meeting for Chairman Powell next Wednesday? How tough is this one?
Well, the meeting itself isn't hard in the sense that they can easily say we're not going to do anything, but how he frames things in the news conference when we start asking about the dot plot and the summary of economic projections.
We being you.
Yeah. That's going to be the hard part because, as many people have shown recently, the market trades completely differently at 2 o'clock when we get the statement, and then from 2:30 when the chairman speaks.
So true, so true. Mike, going to stick with us to break this down for us. Coming up very shortly, Jeff Rosenberg of BlackRock on the payrolls report. Mike Dada as well of Roth MKM. The numbers look like this. The final estimate, the median estimate in our survey, 185,000. The previous read, 150K. Your equity market has been ripping. Your bond market has been rallying. Going into it, futures negative 0.1% on the S&P. In the bond market, yields drifting just a little bit higher. From New York, your jobs report up next.
used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
20 seconds away from the payrolls report. The scores going in look like this on the S&P 500. Equity futures slightly negative by 0.2% on the S&P 500. Yields a little bit higher on a 10-year maturity, up 3 basis points. Your 10-year 4.1816. And in the FX market, the dollar a touch stronger against the euro, 107.71. We're negative 0.2%. With your jobs report, here's Mike McKee. Morning, Mike.
Morning, John. We're waiting for the numbers to drop here, and we come in a little bit higher than anticipated. Not quite as high as Mike Darner was worried about. 199, just under the 200,000 level. 199,000 jobs created during the month of November. 150 of those are in the private sector. 28,000 manufacturing jobs, and that's the rebound coming in from the UAW strike. Now subtract 28 from 199 and you get 171, which is still higher than people had anticipated after you do that math. The unemployment rate, 3.7%. Remember, people were going to telling us we were going to go over 4? 3.7%. I'm going to obviously have to check the numbers in terms of why that happened, which we'll do in just a second, but that is a stunning number. Average hourly earnings, we haven't seen pop up yet, so we're waiting on that. Average hours, 34.4. And we
don't know the revisions yet.
And the labor force participation rate, 62.8. There seems to be an issue with the BLS website. So let's see if everybody's going through that, because we're not getting the data that we normally get.
Take a beat, Mike. Let's go through these numbers. Headline B, upside surprise, 199. Unemployment, 3.7%. The estimate, 3.9. The front end of the bond market, wakey. Yields higher, up 11 basis points, 4.71. Nothing snoozy about this bond market right now. On a 10-year, up by 10 or 11 basis points, 4.25. Getting some wage growth number. Mike McKee, month over month, 0.4%.
Yeah, that's significantly higher than anticipated and double what we saw last month. And it means that it doesn't mean anything in terms of the year over year. I guess base effects come into play, and I'm still not getting all this data, but it's 4% on a year over year basis. And so that tells us that at this point, we're still seeing the progress that you want to see in wages. And that's even with a large jobs number. The revision is in now, a net over 2 months of decline of 35,000. So we don't know which months those are apportioned to, but we do have a smaller number for the net revisions than perhaps people had anticipated.
Take the bond market move, push it through foreign exchange, stronger dollar against the euro, 107.41. In the equity market on the S&P 500, just about session lows, just off them at the moment, negative 0.4%. But Bramo, wow, we were talking about the prospect of a downside surprise. How bad would it have to be bad news? This is good news. Jobs are better than expected, unemployment's lower than expected, participation's higher than expected, and wages are still going. We've said for a while, for Chairman Powell, that script's not going to change on Wednesday, is it, off the back of this?
He's going to have a pretty hawkish message in order to really reflect what this shows, which is a lot more strength than even the headline beat might suggest. When you take a look at that 3.7 unemployment rate, the fact that it dropped by 0.2% from the prior month is pretty surprising. That is what nobody was expecting. But the fact that hours worked also increased. Every metric of this, wage growth increased more than expected. Every metric points to a stronger labor market than pretty much everyone on Wall Street currently.
I agree with that totally. It's just got a gloss here, John, that I would say is very constructive. And to me, the elephant in the room is a smaller revision, is Michael McKee. I got the HP12C out, which says 164,000. 164,000 is a Midland number, but it's a sigh of relief from the gloom that's been whispered out there with revision.
I always say 3 minutes after the payrolls report, sometimes the price action doesn't stick, but this is the early reaction. Yields up at the front end by more than 10 basis points, back through 470 on a 10-year, 425 and up 10 basis points at the moment. Mike McKee have been chewing over the numbers. What do you see?
Yeah, we have some numbers down let's break down the unemployment rate. We do get a big jump in the civilian workforce, 532,000, but we also get 747,000 added in the household survey of people who are employed. That is a huge number. And unemployed drops by 215,000. So this looks like one of those good reasons that unemployment is falling. It's a surprisingly strong household report. And of course, the establishment report is also very strong. In the establishment report, 40,000 jobs in leisure and hospitality, which is higher than it has been in recent months, but it shows that category still looking for people. I wonder how many of those are department store Santas coming on board. Manufacturing, as we mentioned, up 28. Government, 49, a little bit lower than the average over the prior 12 months of about 55,000, but still adding a lot. And healthcare, as always, the big gainer, 77,000 jobs.
Did you just say that was your side gig?
Yeah, I go right across the street to Bloomingdale's. Works like a charm. You don't have to commute. You know, they called me up.
I
They
can
said,
see
please.
that. That works.
They said, you know,
You'd be
they
a good
said,
Santa.
Well, the beard hides a bow tie, so I get away with it.
Be a great Santa. Mike McKee, thanks for that. Let's round things up for you. Equity futures negative 0.4% on the S&P. Bond yields higher, much higher. They fade just a touch, still up by around 9 or 10 basis points at the front end of the curve. On the euro against the dollar, stronger dollar, 107.40 right now in that currency pair. In the next hour to break this down, tremendous lineup for you. Mohammed Al-Arian of Bloomberg Opinion, Rick Reeder at BlackRock, Anastasia Amoroso of iCapital, Mike Collins of PGIM Fixed Income. Plus, I imagine, a very happy Julie Su, the acting Labour Secretary, is going to join us from the White House first, TK, in about an hour from now.
I'll say that'll be an interesting Washington conversation as well. We continue our conversation with Michael Darden, Chief Economist, Macro Strategist at Roth MKM. Michael, once again, it is a confounding report of somewhat towards a fully employed America. Is this the productivity overlay? Is this the technology overlay into non-technological sectors where things are just simply better than we perceive?
Well, it's hard to say, Tom. I mean, the productivity statistics have been really strong over the last 2 quarters, but they were insanely weak before that. So on productivity, we just vaulted back to the pre-pandemic trend so far, which was 1.6% per annum. So to be determined on that question. This is a good report. You know, almost 200K with the downward revisions, you know, we're at or just below the consensus expectation. But we were talking about the unemployment rate moving up to the cusp of a recession signal. Now we've pulled back to 3.7 on the unemployment rate. So this is a report the Fed is going to look at and not really feel compelled that they need to embrace these early rate cuts next year that the market has priced in. Now, this could change again, with the December data, obviously, but at face value, strong report, almost 200K on payrolls, unemployment ticks by 0.2 to 3.7. That's going to be viewed as still a very tight, fully employed labor market. And so, it makes sense that we're seeing a bit of risk off here and a bit of a bounce in bond yields.
Michael, does this make you rethink any of your thesis about the business cycle rolling over?
Not so far. I mean, certainly it's not an additive, decisive signal. This is, if we're up at, up above 4 in the, for this report, then, to me, that would suggest that perhaps we've fallen into recession. So this says we're not in recession right now, but it's not necessarily an all clear signal for next year either.
Michael, you fold with Bloomberg data, your economics into your equity coverage. What's the DARTA SPX call for when you're 51 years old?
Tom, we were talking before about the market really being dominated by 2 sectors and 7 stocks. So, I think for the overall S&P 500, we're going to have a challenging period. The valuations in these leading sectors are simply too high. So I think investors are going to have to look to some other areas that have been underperforming where the valuations are low. We'll have opportunities with rising volatility next year.
Michael Darter, thank you so much with Roth MKM. This jobs day. Futures negative 14, Dow futures negative 94. The VIX well under 13, 12.90. That's most interesting. Lisa, we were at 11 basis points, higher yield, lower price on the 2-year yield. Now we're at 8 basis points. So it's the shock of it, and we've come back a little bit.
All I can say is that if anyone was doubting Goldilocks, well, you can continue trying to doubt it, but each data point that we have gotten really plays into that idea, especially with more people entering the workforce.
A difficult way to manage money in this environment. Jeffrey Rosenberg is portfolio manager for the Systematic Multi-Strategy Fund at BlackRock. Jeff, with great respect, what's the strategy that works forward given the treacherous economic waters we wade?
Yeah, this is a good report, and as we've been discussing, across the board, it's a bit stronger than expected. Maybe not on the headline payrolls, but certainly underneath. And I think that really is going to push back, and I think that's why you've seen the market reaction, the initial market reaction that you just described, is bond markets in particular, were really starting to price in a lot of cuts into next year and pricing them earlier and earlier. 3.7% unemployment rate, hard to see where the restrictiveness is coming for this Fed policy. So I think you're going to have a little bit of pushback in that narrative, in that you're not really seeing the slowdown, particularly, again, with the wage picture. Most of the support here is coming from the inflation side, and we'll have that conversation next week. But on the growth side, you're really not seeing the level of restrictiveness show up yet in the labor markets. And I think that's going to push back on how quickly the Fed's going to be able to cut rates to keep up with the fall in inflation and avoid the unintended increase in real rates.
To Jeff's observation, Lisa, I missed this, stunning. The Bloomberg Financial Conditions Index, I'm going to use this word carefully, explodes out to an accommodative 0.62. It's Greek, right? All you got to know is explodes the right word. This is what Powell does not want to see.
Although he didn't push back as much as some people thought, at least last week in his speech. But you're right, to that point, Jeff, when you say that inflation is really in the front minds of people who are betting on this Goldilocks narrative and even rate cuts without the pain, I wonder how much their view is damaged by average hourly earnings rising more than expected and rising from the prior month. How much does that suggest a stickiness to the labor market strength and wage growth that really flies against this narrative of Fed rate cuts next year?
A little bit, and it there certainly goes in the opposite direction. But what you've had on the inflation side is really this dichotomy between goods and services. And it's the goods part that has really been the disinflation that's fueling the overall enthusiasm for the cuts into next year. The services side is held up, and services inflation is really the mapping of today's labor report and the wage picture into the broader inflation. And so that, remains very supportive. So again, it's kind of the easy disinflation is behind us. This report kind of supports continued support for the broad inflation picture from the services side. And that debate, I think, will continue. And obviously what you've seen in the market is a little bit of pullback in terms of the enthusiasm. as Jonathan says, the first reaction isn't necessarily the end reaction, but I do think the overall take from this report and the wage picture is, again, very strong labor market, supportive of services inflation. Yes, it's still coming down, but most of that is being driven by the goods side. You're not seeing that supported as much from the services side.
Priya Misra of JP Morgan earlier this morning said, does it matter? She raised this question, does it matter how much the Fed cuts rates next year, considering the fact that it didn't seem to matter how much they raised rates. It didn't tighten policy that much. The long lags are long in both directions. Do you think that people are overestimating whether it matters if they cut rates in March or if they cut rates in June or if they cut rates in September, if they have stopped raising rates, and if right now what you're seeing is an economy that still is chugging along and businesses still hiring?
Well, I think the question is, does it matter for the real economy or does it matter for the financial economy? I think the point's well taken in terms of the sensitivity of the economy to interest rates is a different question than the sensitivity to financial markets. And I think on the latter, the financial markets, it matters a lot. And I think that easing in financial conditions that you were just talking about has everything to do with the expectations of soft landing, the collapse in inflation, the immaculate disinflation proving out to be correct and allowing the Fed to cut interest rates. That's highly supportive of financial markets. The real economy point, yes, I would concede that may be less significant. But for investors, it's going to be the latter. It's going to be the financial markets.
Jeff, let's pretend you're at Carnegie Mellon. You got to sum this over from your financial chat over into the GDP chat. Does this good labor economy support a more buoyant assessment of our real GDP?
Well, I think so, Tom. And I think that's, kind of the issue here for the monetary policy outlook is that there is this question of just what is neutral, what is real interest rates, what is restrictive. And we think we're there, but you don't know until it shows up. And we've had the benefit from the inflation side, but the growth side, less so. And I think that's been the message from labor markets. It's been a steady normalization, but we're still seeing very strong labor market prints here, very strong wages, strong unemployment rates that are not really consistent with restrictiveness. And that's good from the growth side, but it may not be good to get that last mile of that 3%, 3.5% inflation down to the 2% target.
Jeff, thank you. Jeffrey Rosenberg, most often with us here on Jobs Day with BlackRock and his good work in shorter term paper as well. Michael McKee looking at page 72 of the jobs report. What is beneath the headline data?
Well, a couple things. Lisa pointed out the average hourly earnings were kind of double what was anticipated for the month, but on a 3-month annualized basis, they're down to 3.4% from 3.7%. So the trend continues to move in the right direction for wages. The Fed looks at 3 to 3.5 as the sustainable level for wage increases at a 2% inflation rate. So they're going to still look for that. In terms of jobs, we mentioned manufacturing up 28,000. We also saw big strength in the healthcare area, which is always the case these days here, 76,800. Government, 49,000. You can see some political attacks maybe forming there, except all of it was in state and local government. Federal government, 0 additional workers, which is kind of interesting. And also, what month is it? This is November. This is the holiday season. Retail lost 38,000 jobs. So it isn't exactly clear how that happened, but.
Do you know off this report what Amazon's doing in the other, the online, those big buildings outside Fargo, North Dakota, where, they're,
Yeah, the interesting thing is employment and transportation and warehousing was down by 5,000 jobs during the month. And we've often seen an offset there to retail as more people move to online shopping, and we didn't get that this time. So it's not clear to me whether we're going to see a big change in that for December, or whether the seasonals have changed.
Mike's going to dive into the data. He'll be with us through the morning and, of course, the afternoon here across Bloomberg Radio and Bloomberg Television, truly driving all of our economic analysis. Gina Martin-Adams is scheduled to be with us here on the equity market. A little more on bonds right now. And, Lisa, we do this. Why don't you bring in Ira? And we have the 2-year yield. We had an 11, 12 basis point move. We've come halfway back, maybe a third of the way back. A little bit more quiescent move.
Yeah, what I find interesting is that the initial headline number would suggest that you might as well really start to pare back your bets on a March rate cut, and yet they weren't pared back all that much. We went from a 55% chance to now a 47.5% chance. Again, a real significant chance still priced into the market that we're going to get rate cuts by the Federal Reserve in the first quarter of next year. Ira Jersey has been parsing through these numbers as well, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence. Ira, what's your take on the fact that, yes, markets moved? They're retracing some of that, even though there is really nothing in this report to suggest that the Fed should start cutting rates in the near future.
Yeah, I think that the market is in kind of risk management mode because the market does think that we're maybe now seeing a pretty significant slowdown, and certainly this is a speed bump in that kind of narrative that the economy is slowing very quickly. But like Mike McKee said, I think part of the issue here for the market is the dispersion and the distribution of the job gains and the job losses. You know, Anna Wong and Bloomberg Economics talk about the SAG strike and the UAW strike having some effect on this. So we'll need to see a couple more prints. And obviously, inflation is still the key to all of this. So next week's CPI number will probably drive some of the narrative that we have from the Fed next week. That's where you can start to see maybe some changes in market pricing for cuts.
Ira, you're a claim over the years, and frankly, your team here at Bloomberg Intelligence is not only on the economics of this, the jobs report, the wither, the yields, and all that, but the confidence in the fixed income markets. I've seen a lot of gloom articles in the last couple weeks, and I've seen a lot of pros push back. What is it? Should we worry about liquidity? Should we worry about trust in the short-term paper system?
Well, I don't think we should necessarily be worried about the trust in the government's ability to pay and willingness to pay at this point, right? You know, we'll have a debt ceiling crisis at some point probably in the future just because of the partisanship that's going on in Washington. But in terms of the size of the market versus the pipes that the market runs through, I think there is some concern there. And the government and some of the regulators are trying to nip at that at the margin, but I'm not sure that they want to take the steps that will actually help increase liquidity in a very substantial way. So I wouldn't worry about T-bills. T-bills are still very liquid. You still have a lot of cash in money market mutual funds. But when it comes to things like, 5-year, 10-year, 30-year bonds, again, every once in a while you're going to see these massive moves on not a lot of liquidity. This morning, liquidity seemed okay. There was pretty tight bid offers for some pretty decent size. But there's a lot of days when we get numbers like this and just all of the bids or all of the offers just completely disappear. And when that happens, you wind up seeing these outsized moves on data that you wouldn't necessarily expect to move the market that much.
Which is the reason why a lot of people are trying to identify where consensus is and where the overshoot could be on any given day. You started out by saying that this jobs report acts as a speed bump with respect to the slowdown narrative. Does that mean that right now the slowdown narrative continues to be the consensus? People are going to price that in, and should we get another report like this, it could cause a pretty big disruption in the opposite direction with yields going higher.
I completely agree with that assessment. I think that if we see that in December the jobs report is reasonably decent, we could easily price out March and May interest rate cut probabilities, and I think that can happen very quickly. I mean, we've gone the other way very fast as well, right? Think about it. Just a couple of months ago, when 10-year yields were at 5%, 2-year yields were at 5.25, we were not pricing for any cuts in all of 2024. So we could easily go back the other way. I've been of the opinion that the bar for the Federal Reserve to cut rates is much higher than the market's thinking. So I think that we eventually will price out those early cuts.
Thank you, Ira Jersey. Thank you so much. Really, really appreciated this jobs day as well with Bloomberg Intelligence. On the other side of the aisle, Gina Martin-Adams is Chief Equity Strategist at Bloomberg Intelligence. Gina, we're looking at the jobs, yield, the Fed. What our listeners and viewers want to know is I'm so far behind in this market. What do I do given this jobs report? And folks, here's the numbers. Amy, give me this if you would on TV. I'll quote it out to radio. Year to date, Standard & Poor's 500 up 13%, the Dow up 5%, and the Gina Martin Adams NASDAQ 100 up 34%. How do you take this jobs report, better than good, folded into maybe a better than good GDP, which is clearly into a better than good stock market?
Yeah, I think it's a great question, Tom, and it's certainly one that everyone in the equity universe is contemplating at this time of year. I would point first to that difference between the Dow's return and the NASDAQ return. You see a similar difference between the S&P 500 return and the small caps return. Portions of this equity market are still in an extraordinary bear market, really reflecting the recession psychology that we continue to contend with, as everything but the jobs market indicators has been pretty sour over the course of the last 2 years. The equity market has been stuck in this sort of recessionary malaise, with a few exceptions, all being tech-related, tech-adjacent stocks have performed incredibly well over the course of the last year. So this is clearly not about the economy in the equity market. The economy is keeping most of returns somewhat suppressed. They're keeping small cap returns, international returns very low. But what's working in the equity market are companies that are experiencing earnings recovery, earnings growth that has nothing to do with the underlying economic numbers. So that sets you up with a really good strategy for 2024. Well, if the economic outlook changes, you've got to change your investment strategy.
Gina Martin, my strategy is to get to Lisa Bramowitz because she's got some really good questions here on the equity markets. But I want to note that equities are beginning to lift now. Futures only -4, Dow futures only -35. We've got a comeback in the market here, and if we get a comeback into next year off of month after month, our surprise in this resilient job economy. Do we underestimate where those blended and tech estimates are going to be in June?
Yeah, we very well could. As a matter of fact, I think there's a very strong chance that the market is mispriced for 2024. And most people would say that the market is mispriced because analyst expectations are too high. Our work would actually say the market is not priced in line with the analyst community. 0% earnings growth over the course of 2024. If anything near the analyst estimate of about 11% growth comes true, that will be another second consecutive year of upside surprise on the earnings story. While we've all been completely and totally captivated by what all of this data means for the Fed, the other half of what really drives stocks is what's going on with earnings, and we very well could be set up for another earnings surprise next year.
Which is the reason why, Gina, part of what's interesting here is that people are underestimating how much capacities companies have to keep hiring, right? The flip side to this story, which is that they see more downside to not being sufficiently staffed than upside from possibly cutting costs. This from Jason Furman of Harvard, just out. We're now 2 million jobs and 2 million employed above the CBO's pre-pandemic projections, that we are actually at a better spot than before the pandemic we were extrapolating out. Gina, where do you see the biggest gain to be had from the figures of we're seeing right now with respect to hiring, with respect to where people are really hoping to beef up?
Yeah, so I actually think the biggest potential gains in terms of hiring are going to come from the areas that already cut. If you think about the longer term scheme of what's happened in the job market, we had tremendous job cuts throughout the pandemic experience. The sectors that did not cut jobs cut those jobs in the end of 2022 and early 2023. Those sectors are sectors like technology, communication, to a lesser extent, financials. So if those are also the groups that are experiencing the most robust earnings recovery, in particular, the tech sector is starting to really produce strong growth, communication stocks producing very strong earnings growth. Those are the segments of the market that are leading what's going on in the broader market. Those are the segments where they're already cut to the bone. If they continue to produce positive cash flow growth, positive earnings growth, we're going to see hiring come back in that space first.
Which, if you flip this on its head, you said earlier that maybe people are focused too much on the Federal Reserve and should be focused more on earnings. At what point do Fed rate cuts or not matter for equity valuations?
Oh, I think they definitely matter. If you look at something like the small cap sectors, for instance, the small cap index is trading at multi-year discounts relative to large caps. It's very clearly suppressed in terms of valuations. When you look at the S&P 500, you exclude the tech sector alone, and you've got a multiple that's closer to long-term average. So there definitely is some pent-up demand that could be sitting on the sidelines for equities. Just based on valuations alone, a cut in the Fed funds rate could go a long way to catalyzing some degree of valuation expansion in all the groups and sectors that have frankly been left behind in this very tech-specific recovery that has emerged in 2023.
Gina, just absolutely brilliant. Thank you so much for that weekend analysis. There's a look ahead with Gina Martin-Adams into next week and that important inflation data, and of course into next year with what we're going to do with our 201ks. Lisa, my head's spinning. Help me here. What's your observation?
Is that it was a pretty good report, and it wasn't good enough to make people good news, bad news, which I know you love. It wasn't good enough to really cause hysteria. But it also was so good that people are now rethinking when the Fed could really start cutting rates. It potentially delays that. I
thought that Martin-Adams was brilliant because she walked away from the Fed analysis to the real economy and what corporations are doing. And as she said, there's a gross underestimate of the resiliency and the adaptability of corporations in different sectors, some not all that great. We know media right now is flat on its back. But the answer here is we're seeing futures come back. The major story, for those of you on radio, spiked down S&P futures, Lisa. We've made a run to flat. Yeah. We're not there yet.
People aren't fully repricing anything on the heels of this report because it's one data point and the rolling average matters more. But here's the issue. How much have people underestimated exactly what you're talking about, Tom, time and again, in terms of just how much strength there is? And if that's the case, then are people overestimating the Fed's response to it next year? It's going to be important to really understand exactly whether that even matters.
We're going to do the Fed decides here. December 13th, I think it is. We're going to do a show in the afternoon. Suddenly, the Fed decides is interesting.
Well, it's always interesting, especially now when we're in this highly uncertain time. And I'm curious whether they care about the easing in financial conditions or if they basically say, fine, it doesn't really matter because we see a slowdown in the works.
Thanks to our team, as always, a fabulous jobs day, really interesting conversations. In the 9 o'clock hour, Jonathan Farrow in conversation with the acting Labor Secretary. Good morning.
Well, that was fun for about 30 minutes. Live from New York City this morning. Good morning, good morning. Your equity market just a touch lower on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Farrow.
From New York coming up, the U.S. payrolls report coming in hot with the latest read on inflation coming up next. Chairman Powell's next move less than a week away. We begin with the big issue, payrolls in America.
Look at the jobs report, non-farm payrolls. It's important.
That's really what we're going to be focused on. Every piece of economic information gives you evidence about what's happening.
Jobs market now is coming into question in terms of how resilient it really is.
We still have more and more evidence pointing in the direction of the labor market softening.
It's not weak, but it's no longer as robust as it was.
We are normalizing. The labor market is hanging in there. The economy is hanging in there.
The general story we have is economy that's slowing.
In order to get a Fed cut.
In order for central banks to really feel confident that inflation is more sustainably at their target.
You've got to see some meaningful degradation in the labor market.
You need to see a little bit more, loosening of the labor market.
Go back to the labor market.
All roads point to labor.
And breathe. Joining us now to discuss, Mohammed Al-Erin of Queen's College, Cambridge, BlackRock's Rick Reader. Gents, always great to do this with you both. Mohammed, what was that?
That was good news for the economy and further confirmation that the U.S. has an exceptional labor market and an exceptional economy. You saw significant wage growth this late in the cycle, significant job growth, higher wage growth, and high labor force participation. And I don't think the fixed income market would have sold off this much had it not rallied excessively in the last few weeks. So bottom line, John, this is good news for the economy. And the market has to think very carefully about the amounts of cuts it is pricing in for next year.
Rick Reeder, where did this come from?
So I'd say a couple of things I would talk about on the show all the time. You know, you have a different economy than you've had in the past. We had 99,000 jobs in healthcare and education out of 199,000 jobs. So what you got to parse the data. And, you know, you don't have this standard cyclical economy. You have a service-oriented economy where we're still hiring a lot of nurses and teachers, and it manifested itself again today. That is the one going forward that I think it's going to be worth focusing on. Part of why I don't really believe in this soft landing, hard landing. I just think in a service economy, you're just driving to a slower economy, but nothing that bad. One other point that I would say, and touching on what Mohammed said, you have a lot of people that are joining the workforce as well. Another 500,000 people come into the labor force. So I think there's something that's important here. You are building the dynamic around more people coming into the labor force. You saw the JOLTS report, some hiring coming down. So you're building slack, but really, really slowly. And again, it's an environment where the Fed can sit back, wait, and then I think the latter part of the year they can start cutting rates. But you know, as Mohammed said, markets were a little overzealous. They were pricing in a March, more than a 65% chance of a March cut. That seems overdone, to say the least.
Mohammed, let's build on that. The difference right now between where the market is and where the Fed is and what they're trying to communicate.
Yeah, it's striking. You know, we've seen this already last year when the market expected rate cuts this year, didn't get them, and the market rushed again and priced in early and significant rate cuts. Look, the Fed is not happy with the loosening of financial condition that has happened in November and early December, and it's been a massive loosening of financial conditions. And what this report confirms is not only that we have a solid labor market, but also, as Rick rightly said, keep an eye on the service sector, because in order to get to 2% inflation, you need goods deflation to continue, and you need service disinflation to accelerate. And I don't think we're going to see the service disinflation accelerating with what's happening in that sector. The bottom line, John, is back to the Fed is really unlikely to start cutting in March, as markets were expecting. I mean, now I think the latest now implied probability is about 47.5% for March. That's still too high.
If that's the bottom line, here's the headline. 199 in the payrolls report, an upside surprise. Unemployment down to 3.7% and wages looking decent. Mike McKee's got the details. Morning, Mike.
Good morning, John. Well, the Labor Department seems to have had a problem with its release, but we have all the numbers right now, and it is 199,000, as you say. Interesting thing, revisions, negative 35,000, and that is all to September. October was unchanged at 150,000. Manufacturing jobs up by 28,000. We'd lost 35,000. That's a return of the United Auto Workers. So subtract that out, and you get 171,000, which is still strong job growth for the month. The unemployment number is the stunner for the month, 3.7%, as more than 700,000 people enter the labor force, more than 500,000 of them new entrants, not moving over from unemployment to employment, but coming into the labor force. And that's going to be greeted with huzzas down at the White House. Average hourly earnings, 0.4, up 4% on the year, and on a 3-month annual basis, up at 3.4%. It had been 3.7 in October. So we're seeing wage growth slow at a time when we're still seeing a lot of jobs out there. Where are the jobs? Healthcare, as always, 77,000 basically, and government 49,000. Interesting thing here for those on the campaign trail, these were all state and local jobs. It wasn't an expansion of the federal government. Leisure and hospitality up 40,000. Most of those restaurants, maybe some department store Santas, except that retail hiring was down by 38,000, and almost all that comes out of department stores. So not clear what's going on there. Coming into this, there had been talk that the SOM rule would be triggered, that when unemployment rises by a certain amount off its lows, that you're in recession. We're not in recession, I think, is the easy way to sum that up right now, John.
Just had 5% plus GDP growth in the third quarter, Mike, and we've just got unemployment down to 3.7%. Mike McKee, thank you. Plenty of takes rolling in. Here's one from Neil Dutter of Renaissance Macro. The labour market is not the primary driver for monetary policy right now. He goes on to say, indeed, there is an asymmetry in the Fed's policy reaction function. Stronger employment will not push them away from a cut as much as weaker inflation will push them towards one. Rick, I'd love your thoughts on that quote right there. Is this labour market no longer a reason to be hawkish?
So I actually think it's right. So there's a couple of things at play here. Does the Fed have to cut quickly because of a real slowdown in employment? Clearly not. We've ruled that out. But there is something, and Mohammed said it. So let's break down inflation. If you take service level inflation, it's running at 3.5. That's down from 8. So the momentum is good. Goods inflation is actually deflating moderately, but it's service level inflation you have to bring down. My sense is that will come down, but it'll come down very slowly. So what does the Fed do? So now take the funds rate. You've got a funds rate at let's say 5 3/8. If you've got inflation, if you've got core PCE, core CPI next year, that's going to get down to 2.5, and we think that's about where we're going. That's the Fed projection. That's about our projection. So you've got a funds rate at 5 3/8. You've got inflation running at 2.5. You've got real rates that are way too high. So you've got to cut rates, I think, 100 basis points to get to what is, quite frankly, a somewhat restrictive level. And I think that's what's going to happen. But it has to be instigated by that service level inflation. As Mohammed said, you're just not going to get core goods that deflate that much. You've got to see some moderation in service level inflation. My sense is you'll get that, but it's slow. By the way, things like shelter come with a lag, so you think that would slow. But there's some sticky things: medical supply, healthcare insurance, auto insurance. Some of those things are just sticky, and they're not cyclical, and it's hard for the Fed to influence them.
Well, let's get to the Federal Reserve. Mohammed, next week, 3-part act: statement, news conference, projections. What are you expecting next week?
So I think they're going to repeat, because they're going to try and push back against the loosening of financial conditions. So they're going to repeat what we heard from Chair Powell on Friday, which had 2 parts. It's premature to talk about rate cuts, and we may still need another hike. I don't think they'll believe the second bit, but they'll need to see it. I think in terms of what they project for next year, I am where Rick is, probably more like 100 basis points of cut than the 250 that the market has. And although they will not tell us that, it's more likely to come in the second half of the year than in the first half of the year. So that is what I'm looking for and expecting from this Fed. It'd be interesting to see how the market reacts. The market, as you know, has had very selective hearing. And it was stunning to me that last Friday, when Chair Powell tried to push back against what had been the massive loosening of financial conditions, he basically got sidearmed, or I think you called it steamrolled, is the phrase you used that day, by yields coming down 10 basis points, despite what he said. So it's going to be interesting to see how closely the market listens to the Fed. But the market right now is totally ignoring Fed forward policy guidance.
I'm pleased you brought that up, Mohammed. Rick, let's talk about it. Mohammed's right. Chairman Powell got absolutely steamrolled. If that was pushback, this bond market looked right through it and laughed. Is Wednesday going to be any different?
So with a couple of, by the way, we also get a CPI report that's probably not going to be that soft. So listen, so I don't think Chairman Powell will be very different. But let's break down the parts of the yield curve, because I think it's worth describing this. The very front end of the yield curve. We've been on the show many times talking about buy the front end, buy the front end, buy the front end. This month, it was time to sell the front end. The front end got crazy overdone. There's something that's really important, though, and it's something that they're really going to be focused on. If you take the long-term Fed funds rate and you assume that it's going to be 2.5, maybe a little bit higher than that, the one thing that I think you can start doing now is I think you can start buying to the belly of the, we talked about it this month, and I think in your show and others, you can start buying out to the belly of the yield curve, because the forwards are now pricing in a level that is not there where the long-term funds rate is. So I think, quite frankly, you can be more comfortable today. Forget the front end, other than some cash management, obviously. But I think the belly of the curve, if you get some nice, hopefully get a backup here. And I think the forwards are interesting, and I think you can now hold some interest rate exposure, because I think we're done on hikes, and now we can start thinking about longer term cuts, and that's where you can get paid for it out more a bit further out the yield curve.
When you speak to people, are you seeing appetite to do just that, Rick? When you say the belly, we're talking about what, 5, 7s coming out of front end? Is that happening?
Definitely. So 3 to 7 year part of the curve, and 100%. And you've seen some of the flows. By the way, you saw some flows, significant flows on the back end of the curve. That's pension, et cetera, that was driving the back end to pretty aggressive levels. But that is, I would argue, largely non-economic, defeasing or locking in your funding against your liabilities. But yeah, there is definitely some. I think as you get into 2024, people are going to get more comfortable with inflation, the persistence of a stable to lower inflation, and more of that are people are going to say, you know what, I want to lock these yields in because we're at pretty good yields. If we're getting to, so let's say economy GDP runs at 1.5-ish or maybe a little lower next year, and you get 2.5 inflation. These yield levels for, you can buy quality assets, quality yield at 6%, 6.5. People are going to have started, and are going to start locking that in.
Mohammed, final word. Do you agree?
I do. I think the harder call, and you should give the final word to Rick, the harder call is what do you do with U.S. credit, where spreads have really compressed. And a lot of people were hoping that they would get both the yields and the spread benefits to their bottom line, and both things have come down significantly. So I think the harder call right now is what do you do with U.S. high yield, for example. Rick?
That's too hard a question. So I said a couple of things. I think Mohammed's right. I think spreads, particularly in high yield with an economy slowing, it's just okay. Investment grade credit, though, and I completely agree, the spreads aren't that sexy, but because you think about what happened when rates were at zero, all these companies termed their debt out, including European IG, which I think is pretty darn attractive because of the cross-currency basis, but they termed their debt out. So now they don't have a maturity wall, and you're buying, because the risk-free rate is so high, you're able to buy things like European credit as a dollar investor at 6%. Investment grade credit. So I totally agree on spreads, but for higher quality credit that you're not really worried about a default cycle, I think the yields are okay, and or not okay. I think the yields are attractive, and I think a year or two from now, people will say, "Gosh, that's a pretty good way to finance companies if you go buy good quality companies at these sort of levels."
We've got to talk about stocks as well. We'll do that next. Rick Reader, Mohammed Al-Arian, two of the very, very best sticking with us. In your equity market at the moment, going into the opening bell, futures were much lower. We've bounced back. We're down by about 0.2% with some movers. Here's Abby.
Let's keep it super simple, John, and really take a look at what is being impacted by that hottish jobs report, and with yields backing up really sharply higher. Not surprisingly, we have some of the big tech names coming under pressure, puts valuation into the spotlight. The idea that liquidity could be coming out of the system. Amazon down about 0.7%. Alphabet is down more, given its greater than 5% move higher yesterday on enthusiasm for its Gemini product. Take a look at Meta, down 1.3%, really one of the laggards within the underperformance of tech. Probably, John, having to do with the fact that this stock, Meta, up 170% on the year. Investors wanting out of some of those big movers, at least today.
Abby, thank you. More from Abigail around the opening bell. Coming up on this program, President Biden promoting his economic agenda.
All across America, instead of exporting jobs, companies, both foreign and domestic, are creating jobs here in America and exporting American-made products.
We'll get the latest from Capitol Hill following an upside surprise on a payrolls report, plus a little bit later a conversation with PGIM's Mike Collins and iCapital's Anastasia Amoroso.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Created close to, remember we're told we're not going to be the manufacturing capital of the world. How can we be the manufacturing capital of the world again? Well, we've created close to 800,000 manufacturing jobs, almost twice as many as the previous administration did in all 4 years. The unemployment rate has stayed below 4% for over 20 months in a row, the longest stretch in 50 years, and all across America. Instead of exporting jobs, companies, both foreign and domestic, are creating jobs here in America and exporting American-made products.
President Biden touting his track record on job creation last week in Colorado, touring the country to promote his so-called Investing in America agenda. Biden set to speak at 5:45 Eastern Time from Las Vegas before heading to LA for a campaign reception. This as November payrolls come in hotter than expected, with the unemployment rate falling to 3.7%. Joining us from Washington, AMH. Morning, Anne-Marie.
Good morning, John. Well, the 3.7% unemployment rate, as Mike McKee says, that is a stunner, and that is going to be celebrated at the White House. You heard it from the president there. Every single statement for the past 20 months has been, we remain below 4% when it comes to unemployment rate, and I expect him to tout that statistic today. We need to remember, when it comes to politics in this administration, the issue is, as Mark Zandi has put it at Moody's, it is colored by inflation. He says that American families are spending more than $700 a month than they were before the pandemic. So Biden is still dealing with these issues of prices. Our Bloomberg News Morning Consult poll showed that Americans are frustrated and they see more prices are going up, and they actually trust the former president, Jonathan, when it comes to the economy. But when you're looking at inflation, and this is the heart of the matter, potentially the timeline could be on the president's side. Already, what are we seeing today? $3.18 per a gallon of gasoline. Something that dogged the administration last summer is starting to come on their side. So potentially their timeline could help them when it comes to the inflation story. But today they have good news to tout when it comes to the jobs picture.
MH, no doubt we'll hear them talk about it in just a moment. Anne-Marie, thank you. Mohammed, another poll, CNN, here it is. More than 4 in 10 saying they're seriously concerned about rising costs, pushing them out of their own communities. Mohammed, talk to us about this disconnect between what they tell us is good about the economic data and what many people in this country still feel.
Yeah, and it must be so frustrating for the White House. Not only is the unemployment rate below 4% yet again, but Jason Furman pointed out this morning that relative to where the CBO thought we would be at this point, we have 2 million more jobs. So there is no question that this economy has created lots of jobs. There's no question that this economy has delivered higher economic growth than most expected and that most other countries have achieved. But as Anne-Marie points out, the problem is inflation. And you have to understand the psyche. For the person in the street, lower inflation means prices come down. In fact, even the White House, as you pointed out last week, got confused on this. It doesn't mean prices go up at a slower rate, which is what it should mean, but in their head, they will not feel that there's been progress on inflation until they see prices come down. Now, they've seen it in gas, but they haven't seen it at the grocery store. And that's why this administration is not getting the credit it deserves for what it's done on the economy.
The administration was taking shots at corporate America for price gouging, all kinds of things, Rick, falling on deaf ears. Let's talk about pricing power, Rick. Right now, in the equity market, where is it?
So pricing power for stocks or
for companies, for stocks, and what that ultimately means for the equity market more broadly?
Yep. So listen, I think price elasticity is coming back in some areas. I think in parts of retailing, you look at electronics, furniture, apparel, that I think it's staple, even parts of staples. Like, I think you're running out of room now of increasing prices. You're seeing at restaurants, you're seeing that today, that I think it's really hard to keep increasing increasing prices. And so I think that's really different going forward. And now you're starting to see, and the Fed's talked about this, you're starting to see more promotional. You look at retailing, Walmart's talked about it, Target's talked about it. You see more promotional, more couponing, more less big ticket item. So you're seeing a shift there. Where is there still stickiness? And we talked about this before. Look at insurance. Like, it's pretty incredible. And you see this in all the inflation reports. Look at insurance. Still, they are still raising prices. You look at medical, again, somewhat because of the demographic of where we are in the economy. And then tech. I mean, listen, I think the expenditure on tech, well, so keep the economy, CapEx in a good shape, the economy in good shape, is, tech is still very much in demand, particularly in places like AI or software. You look at software stocks. If you can create more efficiency within your business, grow your margins, keep your costs down, people will spend for those types of technologies that create real cost reduction for you. Because I think you've reached a pricing point for your organic product that is hard to raise now.
Gents, before you run, can I get one-word answers from you both? Just pick a month. When's that first cut going to come? Rick?
I was hoping Mohammed would go first. So when is the so May to July? So somewhere in there. Can I? And it's a funky. So somewhere in the middle, June-ish type of.
Mohammed?
Yeah, I was going to say June, July.
Okay, in the summer, going into the second half. Rick, Mohammed, just two of the very best. Always a privilege, a pleasure. Coming up on this programme, the morning calls, and later, payrolls growing, wages rising. That conversation with PGIM's Michael Collins, iCapital's Anastasia Amoroso.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Down a touch. Let's get you some morning calls this morning. Your first one from Deutsche Bank, downgrading KB Home to sell. $46 price target, reflecting the stock's valuation and slowing returns. Morgan Stanley downgrading Qualcomm to equal weight, expecting limited upside as the inventory correction runs its course. And finally, Citi downgrading Deckers to neutral, seeing a more balanced risk-reward after recent gains. That stock just about unchanged. Coming up, PGIM's Michael Collins and iCapital's Anastasia Amoroso around the opening bell. Your opening bell is just around the corner.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Let's get to the opening bell and get you to the weekend. 20 seconds away from that opening bell this morning. Good morning. Equity futures negative here by 0.2% on the S&P 500. Down on the Nasdaq by 0.5. Looking at that, you would have no idea that on the surface we just had a labour market report that looked pretty decent about 60 minutes ago. We'll get beneath the surface with the administration in just a moment. There's your opening bell. Switch on the board and get to the bond market. Yields shaping up as follows. Higher on the long end on a 10-year by 7 basis points, 422. At the front end on a 2-year, yields a little bit higher than that earlier this morning, up by, let's call it 10 basis points to 470, 469 on a 2-year. That means you get some dollar strength, some euro weakness. The euro against the dollar down 0.5%, 107.40. And in the commodity market, in the 60s earlier this week, back in the 70s, just about $70.60, up by 1.9% on the session. About 30 seconds into this session right now for the stock market, we're negative 0.2% on the S&P. On the Nasdaq, we're down 0.5. One stock to watch at the open is Lulu. Q4 revenue guidance falling short of estimates. Abby has more. Hey, Abby.
Hey, John. And the stock is showing that disappointment, down 2.9%. Its worst day in about 3 weeks. It was a high bar quarter. This stock into today up about 45%. So investors are expecting a lot. Plus, they typically do deliver. So the quarter that they reported was very solid. But the fourth quarter guide, as you just mentioned, they're looking at growth of 13 to 14%. Last year, it had been 19%. So really missing the mark, or excuse me, the estimate had been 19%. The CFO, in fact, saying that they are being prudent with their planning. That's another way of saying they're being conservative. Some investors could even look at that as this company that typically does put up big numbers and big guidance as sandbagging, and that maybe it's an opportunity for the stock. On the other hand, there are some analysts out there saying that the stock has peaked from a technical perspective. You could make that case. On the day right now, putting all of that together, John, down 2.7%.
Abby, thank you. Just to raise in some of those losses about a minute or two into the session, we're down by 0.1% on the S&P. On the Nasdaq now, down by 0.3. Some M&A in the industrial space. Honeywell striking a $5 billion deal to buy Carrier Global security business. Alex Semenova has this story. Hey, Alex.
Hey, John. Good morning and happy Friday. This deal by Honeywell International to acquire Carrier Global security business is set to total $5 billion. That's according to a statement from the company. The Wall Street Journal had also reported this earlier. Carrier shares are climbing 6% this morning, and the move by Honeywell is meant to broaden its portfolio of product offerings to include this unit, which which makes electronic security locks for large corporations, hospitals, and hotels. It's also part of a move to broaden Honeywell's building automation segment amid a greater demand for cloud-based products. The deal for Carrier's security segment is also part of Honeywell's plans to shell out at least $25 billion over the next 3 years on M&A, capital expenditures, and buybacks. Carrier is expecting proceeds of about $4 billion on this deal, which it will use to pay off its debt. And this move higher bodes well for Carrier, which has had a pretty good run this year. Shares up about 28% year to date. Honeywell, however, down about 7% on the year.
The shares of Carrier up by about 5% on the session. Alex, thank you. Let's get you the update at the moment, 3 minutes in, just a touch lower on the S&P. If you've missed all this, you've missed out in the last hour. Payrolls came in at 199. The estimate was 185. The unemployment rate dropped to 3.7%. The estimate was 3.9. Wage growth month over month, 0.4%. We were looking for 0.3. That is a decent payrolls report on the surface. We can get beneath the surface in just a moment. But that meant you push that through the bond market, yields up big time at the front end by 9 basis points on a 2-year, 468. And in the FX market, stronger dollar, weaker euro. A few more acts to play out going into the Federal Reserve decision on Wednesday. We still need to get through CPI the day before, then retail sales later in the week as well. Let's turn back to earnings briefly. RH, formerly known as Restoration Hardware, delivering a disappointing outlook for the holiday season. Simone Foxman on top of this one. Hey, Simone.
Hey, John, yeah, and it was a pretty ugly third quarter for this company as well. They specialize in upscale home furnishings. Revenue down 14% year on year in the quarter. They cut their margin forecast, and this appears to be what analysts are really focusing on for next year, 13.6 to 14%. They had previously seen 14.5 to 15.5%. Barclays, they're one of the few strategists that are actually positive on this name. And they said this was a big negative surprise. So even a big negative surprise from someone that's pretty supportive of the company. One bright spot, we did see losses in terms of earnings per share, but they came in less than anticipated. They were 42 cents. The expectation had been for a loss of 96 cents. Really negative commentary here, too. Interestingly, they pointed out a headwind from the Israel-Hamas war. I don't think we've seen many retailers really point that out. But high mortgage rates, bad for home furnishings. They say the market has become more promotional, real focus on clearance products. And they're going to even delay mailing a source book of modern home furnishings until next year. So pretty disappointing results for them.
Down almost 11%. Simone, thanks for that. Broader market, negative 0.1% on the S&P. Big payrolls report about an hour ago. Let's start that conversation with PGIM's Mike Collins, iCapital's Anastasia Amoroso. Anastasia, you've had an hour and 5 minutes to chew over that. What was that and where did it come from?
Right. Well, my thoughts on this payrolls report is that it certainly doesn't make the Fed want to cut interest rates at this juncture because clearly it exceeded expectations. But I will say it's probably not as hot of a report as maybe it does show up on the surface. And I say that because, first of all, you've got the unemployment rate that did tick lower to 3.7%. But if you look at it, it's still within the uptrend. It has not been linear, but unemployment rate has been creeping higher. But you did have months when it was lower, but it's still amidst this higher trend. And then you look at the payrolls number, 199 on payrolls, is within that same declining trend of payrolls over the last 12 months. So I think the Fed is likely to look at this and say, this is okay. This probably shows some loosening in the labor market, and it's certainly not a very hot report. Having said that, I think the Fed is months away, if not quarters away, from cutting rates, and this report certainly is not going to make them want to do that anytime soon.
Mike Collins, do you agree? Is this worse than it looks?
It is a little bit on the margin, Jonathan. And if you take out the rebound we had from the strikes and the huge increase in healthcare workers, the actual job gains from a cyclical perspective were actually pretty weak. And if you look at the average hourly earnings, which seem on the surface to be strong, again, a lot of that was that manufacturing sector, the higher wages we're getting from the unions. But you look at the services sector, average hourly earnings, it's continuing to moderate, right? So I think, it's the same story. It's a moderating story here. It's a supply side boom that we've gone through, right? I mean, 2 years ago, Jonathan, the demand for labor relative to the supply was 8 times. A year ago, it was 2 times. And now the supply of labor, for the first time since pre-COVID is outpacing the demand. So I think what's lurking underneath the surface is people are working harder and working longer and taking on more jobs to just maintain the standard of living that they've gotten used to, and that's why we're seeing these big high-end retailers really start to see a pushback.
Yeah, Mike, the story you describe is not a good one. So with all that in mind, Anastasia touched on it. Mike Collins, what do you expect from Chairman Powell on Wednesday?
You know, I think he's going to toe the same line and try to push back on the significant easing of financial conditions, Jonathan, you know, and you know, push back on the 5 rate cuts that are priced in for next year. I do think maybe in the near term, the rally in rates we've seen, the expectations for Fed rate cuts might be a little overdone. But really, when you step back, what's priced in terms of Fed rate cuts, Jonathan, are like a 75% chance that they cut 3 times next year, which is really our base case, but a 25% chance that they cut 275 basis points next year back to their kind of long-term target. And that's what the markets are grappling with. And the first scenario is a good one for markets. That's a soft landing world. The second scenario is a world where the Fed is way too tight and behind, and the whole rate structure goes lower, and probably risk assets sell off in that environment.
So, Anastasia, risk assets so far year to date have been really good. On the NASDAQ 100, up something like 45%. You've been constructive right the way through it for most of this year. Where are you now, Anastasia, on stocks?
Well, I think Mike makes a really good point. What really matters for stocks is why and how quickly does the Fed ultimately cut rates. And if they cut preemptively because inflation has eased and the economy has eased but not slipped into a recession, if they do deliver those rate cuts, then that is a very positive scenario for equities. And we can have sort of a replay of soft landing that we saw in 1995 and the positive returns. Now, on the flip side, you know, if the Fed does fall behind the curve this time on cutting too late and the economy does slip into a recession and or defaults and delinquencies, you know, really sufficiently rise, then that's more of a 2007 scenario. Now, I want to rule that out right now because even though I do think there are pockets of stress in the economy, none of them are systemic, and some investors will take some default risk, but that shouldn't wipe out the whole economy. So I think I'm in the camp that the returns for equities for next year are likely to be mediocre, let's say mid-single digits, unless the Fed really quickly cuts interest rates. And I think you can have a more bullish scenario. So I think equities are worth staying in, you know, for either mid-single digits and higher returns if the Fed delivers.
Anastasia, sticking with us. Anastasia Amoroso alongside the brilliant Michael Collins. We'll continue the conversation. This is what we'll do. We'll reset the price action. In just a moment, we'll catch up with the administration, the acting Labour Secretary, Julie Su. That conversation just around the corner. And then Mike and Anastasia will weigh in on what they heard and where they think this market is going into next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain
a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. You know, we don't have the luxury of saying we can temporarily stock out on our product because these products, these medicines keep people alive.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
City on Bloomberg TV and radio. I'm Jonathan Ferro. Pleased to say that joining us now from Washington is Julie Su, the acting U.S. Labor Secretary. Acting Labor Secretary, wonderful to catch up with you. It always is. I want to go back to 8:30, just briefly if we can. I got a lot of feedback at 8:30 Eastern Time about not being able to access the BLS website to get this information, to get this data. I'm told that the message they got on the screen was you are blocked from the BLS website. What was going on at 8:30? What was the difficulty?
I don't know what happened with the website. I will say that our jobs numbers today show that 199,000 jobs were added last month, that we have the lowest unemployment rate for the longest period of time since Diana Ross was at the top of the charts, and it reflects continued steady growth in our economy. I'm sorry to hear that you weren't able to get that, but I'm happy to talk about any of the data that's come out.
Well, let's talk about it coming out next month, and the month after that, and the month after that. Can we revisit the lockup, Julie, and have a lockup and make sure this data gets out efficiently and effectively, given it's probably the most important data point on the planet?
I completely agree on the importance of the data. You know, we come out to talk about it every time because it demonstrates the health of the economy. It demonstrates, you know, whether economic policies are working. And what we've seen is steadily, since President Biden came into office, 14.1 million jobs created, again, broad-based across numerous sectors, low unemployment rates, and real wages rising. So we are very happy to make sure that you are getting the information that you need to help us tell the story about the impact of Bidenomics across the country.
You really don't want to talk about this, do you?
No, I'm not trying to avoid it. I obviously believe that the data has to be available.
But it's not.
To all of you.
And it wasn't. So how can we fix that for next month?
I hear you on that.
Okay, maybe you can respond to me in the future at some point in the next week or so, and I can share that answer to our listeners and our viewers. Let's talk about the data. On the surface, it looks great. This is from Capital Economics this morning. The response from them this morning, just going beneath the surface, respectable organisation saying this, the 199 increase in November payroll employment included 47,000 workers returning from strikes. Stripping out that one-off boost, the 152 gain was roughly the same as the muted increase in October. Moreover, of that 152, 49,000 were government jobs, a further 77K in healthcare. Excluding those non-cyclical sectors, the economy added only 26,000 jobs, which adds to the evidence that after a very strong third quarter, growth is slowing to a crawl in the fourth quarter. Julie, what would you make of that?
I think what we're seeing is, again, we look at overall trends in the economy. We've seen job growth at record rates, certainly faster than anybody predicted coming out of the pandemic. But it wasn't just like, you know, one-time boost in the immediate post-pandemic months. It's been year-over-year growth. We're also seeing it across numerous industries, and we're seeing it in, you know, overall, right? Over 800,000 jobs created in construction, over 600,000 in manufacturing. manufacturing since President Biden came into office. And yes, we also saw workers come back on the payroll after strikes that resulted in record wage increases and other kinds of benefits, retirement benefits, health benefits that we really associate with what we want for working people, right? It's what gives families a sense of security. It's what gives individuals what the president always talks about, which is some breathing room. And that's the kind of economy that we want to build, that we are seeing. We have more work to do, and we'll continue to build on the progress that we've made. Many of the investments that the president has helped to make possible are showing up in communities, 40,000 some infrastructure projects across 4,500 communities all across the country, but we're just beginning with that. And so we'll continue to see more of that, and the jobs numbers are just another, indicator of that growth and what its impact means.
Why do you think this is not resonating with the electorate? I'll share some polls. CNN, more than 4 in 10 saying they're seriously concerned rising costs could push them out of their own communities. Bloomberg, together with Morning Consult, only 35% of voters in 7 swing states trust Biden on the economy. Where's that disconnect coming from?
Right, so one thing President Biden does talk a lot about, to your point, is we want to make sure that there are jobs in communities so people can get jobs and build a family and join the middle class without leaving the place that they work, that they live. I was with him when we went to Belvedere, Illinois, where a plant that had been shuttered is now being reopened because of the agreement between the UAW and the Big Three. I do think some of this is still, we had global, pandemic and the economic wreckage that resulted immediately in the aftermath of that. Again, we've grown back from it, but the sense of insecurity, I think, remains, and that's legitimate. The other thing, just from traveling around the country and talking to folks, is I think that part of this is that people really do see, there's jobs being created, there's training programs that are connecting them to those jobs, but there remains deep inequities in our society, and part of that is the huge gap between CEO pay and frontline worker pay. So I talked about Diana Ross. I talked about the good news that we are having unemployment levels at record lows for the longest stretches since 1970. In 1970, the disparity between CEO pay and frontline pay was something like 20%. Today, it's over, it was like 17 times higher, the CEO pay from worker pay. Today, it's something like 344 times. That doesn't feel fair to people. It doesn't feel good. And that's why President Biden talks about building an economy from the middle out and the bottom up, where working people and working families do well, not just the wealthy.
Yeah, he's had a lot to say about corporate America as well. I'm going to share a tweet from the president with you, and I want your thoughts on it. I want you to translate it if you can, because I don't understand it. It says, "Let me be clear to any corporation that hasn't brought their prices back down, even as inflation has come down. It's time to stop the price gouging, give American consumers a break." What is the president talking about?
The president is saying that we have a job to do in this country, and we want working people and middle-class families and every community across the country to have the things that they need to live a decent life. We want safe roads and new bridges. We want clean drinking water to flow out of every faucet.
Yeah, I get that, that's great. I want that too, but just this tweet specifically. Inflation is slowing, but it's still positive, so prices are going up. But the president's saying inflation has come down. Why are corporations still price gouging? That's just, economically speaking, just absolutely flawed. So acting Labour Secretary, who writes these tweets, what's he talking about?
I mean, he's saying that we're all in this together, and we will pursue economic policies that help to bring down prices and control inflation, but everyone's got a job to do on that. And we, when there are record profits by companies who are continuing to keep prices high, we'd like them to play their role in making sure that people can afford the basics they need in life.
Appreciate it. Judy Su, thank you. The acting U.S. Labour Secretary. Anastasia Amoroso, Mike Collins back with us for more on this. Anastasia, big disconnect between the administration at the surface and what's happening beneath the surface and how people feel. Anastasia, what explains that from your standpoint?
Yeah, I mean, I think one of the points that Julie did talk about, which is the income inequality. I mean, there are definitely stats out there that show that the top 20%, for example, today, the gap between the top 20% income and the bottom 20% income, she's correct, has grown quite significantly since 1975. So I think that does explain some of the insecurity or some of the lack of economic insecurity sentiment that is out there. I think that's one thing. The other interesting point that I thought she made was on the infrastructure side. And that is right, that the infrastructure stimulus that has been passed now several years ago is still working its way through the system. So I think when we wonder, why is the labor market continuing to be so resilient? Why is the economy continuing to be so strong? It's because all that, backward-looking fiscal stimulus is still working its way through the economy.
Mike Collins, your take?
Yeah, I mean, obviously, Jonathan, to your point, jawboning companies to lower prices is not going to work. What will work is consumers pushing back on the elevated prices. I was looking at an index of food prices this morning, Jonathan. Food prices are actually down globally 25% from their peak a year and a half ago, right? So to us and to Wall Street and to the Fed, that's disinflation, but they're still up about 10% annualized since the pandemic, and that's what people are feeling, right? Those are the prices that they're really struggling with to afford, and it's not just food, right? It's across the board. So Biden can do all the jawboning he wants, but what's going to get prices to come down is weaker consumer demand. High prices themselves will obviously cause more disinflation. So I think we're on the right path. I mean, disinflation is happening. It's happening slowly, but it's moving in the right direction just because of macroeconomics and supply and demand.
Mike Collins, Anastasia Amoroso, to the two of you, thank you. About 23 minutes into the session, equities just about unchanged on the S&P. Your trading diary up next.
The reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million cars every year.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
26 minutes into the session, just about unchanged on the S&P 500. Here's the trading diary. What you need to be looking for going into the weekend and into next week. Tuesday, the latest US CPI report. Wednesday, PPI numbers just around the corner. Then the big one, Fed Chair Jay Powell at a news conference off the back of their decision. Thursday, the ECB's turn, along with the Bank of England from New York City. That does it for me. Thank you very much for choosing Bloomberg TV, and have a wonderful weekend. This is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Studios. Bailey Lipschultz here with Manus Cranny. Matt Miller and Paul Sweeney are both off today. Busy day from the economic standpoint. Hot jobs number. We just got University of Michigan sentiment data coming in. But regardless, we are seeing S&P and Dow both trading higher. It does seem like, Manus, investors may be wanting to shrug off some of that economic data and really focusing on what we have ahead next week with CPI print and all eyes ahead on the Fed.
Yeah, I mean, you've also had a dramatic repricing in the oil and commodity and gas markets. Just think a year ago where gas prices were. So perhaps this market is trying to take itself forward into next week's numbers. But the unemployment rate at the lowest in 4 months at 3.7% was indeed the overall shock of the payrolls numbers, adding at 199,000, strip out the auto workers, and you're left with a pretty much at the market assumption. The bond market didn't like it, did it?
No. Did not one bit, and we will get into some of the drivers and stocks moving under the hood with Norma Linda in a bit. But before that, we will jump down to Nathan Hager with a Bloomberg Business Flash. Nathan?
Okay, Bailey, it is all about the data this morning. We check the markets all day long here on Bloomberg, and after that stronger than expected payrolls report, all of a sudden we are seeing stocks move higher off the back of sentiment data from the University of Michigan coming in a lot stronger than expected as well. The Consumer Sentiment Index jumping 8.1 points, topping all expectations from economists surveyed by Bloomberg. And year-ahead inflation expectations way down, according to this survey, had been 4.5% for year-over-year inflation. Now, the expectation is down to 3.1. And look at this. All of a sudden, stocks across the board in the green. The S&P 500 right now up 7 points. It's about a 0.2% gain. 45.91 is the S&P level. The Dow Jones Industrial Average up 0.2%, up 68 points. The NASDAQ kind of swinging between gains and losses. Now little change to lower, down 4 points at 14,338. A lot of focus on the jobs data. Moments ago, we asked Acting Labor Secretary Julie Su if we would see this kind of labor strength if it weren't for the return of striking auto workers.
Yes, we also saw workers come back on the payroll after strikes that resulted in record wage increases and other kinds of benefits, retirement benefits, health benefits that we really associate with what we want for working people.
Yeah, that was Acting Labor Secretary Julie Su speaking moments ago with Jonathan Farrow on Bloomberg Radio and Television. 10-year Treasury right now is down 19/32 for a yield of 4.22%. NYMEX crude is up almost 2.5% now, trading above $71 a barrel at $71.04. Gold is down 1% or $21.40, trading at $20.2540 per ounce. The euro, 1.0759 against the dollar. The yen, 144.05. That's a Bloomberg Business Flash. Bloomberg Markets is on now with Bailey Lipschultz and Manus Cranny.
And thank you, Nathan Hager. We are going to have a pretty packed show in the next hour. We're talking to CEO of LaSalle Network, Tom Gimbel, on the jobs report, as well as Nancy Tengler, the CEO and CIO at Laffer Tengler Investments, joining us in studio here in New York to talk jobs numbers and that outlook for the Fed going into next week. Right now, we are joined by Bloomberg Markets reporter Nora Melinda. Nora, Manus, and I were talking. We're seeing reactions across cross assets to that jobs report. Maybe a bit too hot to handle, and looking at a bit of a rally along best performers in the S&P, energy, materials, industrials. Laggards are communications and utilities. But you're looking at some individual stocks this morning. What's on the top of your mind?
I am. So I've got a decliner for you, Bailey. Looking at HashiCorp, that's ticker HCP. It's down more than 20% in trading this morning for its biggest slump since June. After several analysts have cut their targets on the software company, saying after the company posted third quarter results that showed a slowdown in key metrics such as revenue. That stoked multiple worries about muted growth and especially the outlook for 2025. An analyst from Cohen actually did say that, quote, it's still tough to see light at the end of the tunnel.
So never something that you want to hear. So we're continuing to see earnings coming in from, as you mentioned, they're in the software space, really kind of showing maybe a bit of that uncertainty. Is this really all macro driven? Is this fundamentally driven to the business with some of these concerns?
I mean, some of these are fundamentals. Between smaller deal sizes and smaller upsell deals, analysts are worried that management may need to right size the business again if the top line doesn't begin to inflect over the next few months.
It's interesting. I mean, when you mention deals, you then look at Honeywell. Honeywell in a $5 billion deal. So what's the justification for it? What are they buying? It's going to be their biggest acquisition in 8 years.
Right. And Manus, so Honeywell did say that it will acquire Carrier Global Corporation. We've got Carrier stocks up more than 7.3% in their biggest gain since November of 2022. Honeywell, this marks its biggest deal since 2015 and its first major acquisition under the company's new leadership. That jet engine and gas detector maker has been pushed by investors for quite some time to juice its growth more through larger deals. So this is obviously very welcome news for the company.
They're paying, 13 times earnings on this? I mean, if you look at the earnings multiples on some of the Mag 7, and then you look at these bigger industrials, and you look at the multiples on those, you then begin to understand how bifurcated this market is.
Definitely.
And well, we're really seeing, in the intraday trading, as you mentioned, we're seeing, obviously, investors rotating to Carrier and dipping out of Honeywell, if you will. But the thing that stands out to me is Honeywell is obviously such a well-known company. It's a $129 billion market cap. It's been around for quite some time. They're known for buying companies and spinning out companies. So I guess, Nora, what do you make of kind of this deal and the broader landscape where we've seen M&A IPOs, for the most part, being quite dormant for about going on 3 years now?
Right. I mean, this is very welcome news. Investors are very excited for Carrier. We do have Honeywell shares slipping as much as 2.4% in this morning. And as you said, that is a very big name. So it is interesting to see this bifurcation here. I did want to hop over to another stock. We've got Digital Realty. That's up in my alley. I cover home builders and U.S. REITs. So this is a data center REIT, and it's up as much as 2.4% this morning. And while it's pared some of its gains, traders are excited after Blackstone struck a new venture with the company as it expands its bet on data centers. We know that this is all, of course, in the landscape of AI, everyone wanting to up their investments in the space, but The two companies, both Digital Realty and Blackstone, will seek to develop 4 data center campuses located in Frankfurt, Paris, and Nova, which is Northern Virginia. Sorry, I'm from Virginia. I had to clarify.
Gotta explain for us. I'm an East Coast man. She's not from Virginia.
Yes, but this is going to be a really interesting deal, and Digital Realty shares are popping a little bit off of this news.
Yeah, what else is going on, though, in that realty space, REIT space, Nora, just kind of top of mind where we're seeing, for the most part, over the last month and change, a pullback in yields, and how does that impact the business?
Yes, I mean, of course, it's really impacted commercial real estate, specifically in the space as I look at offices, for instance. When we did see everything happening with the Treasury yields, about a month back, office REITs and generally commercial real estate stocks as a whole were plunging. I mean, of course, we saw a lot of sectors affected by it in particular, but as we move into earnings season and these companies begin to report in mid-January, all eyes will really be on the fundamentals and how these companies can respond.
Interesting stuff. Nora Melinda, thank you so much. Our equities reporter extraordinaire, Nora Melinda, talking about some of the movers here on Bloomberg markets right now. Going to pivot a bit away, Manis, looking at the jobs data. Headline on the terminal, one of the stories that read spiked, U.S. labor market defies slowdown forecast in broadening strength. Right now, want to bring in Tom Gibble. He is the CEO at LaSalle Network, joining us on Zoom. Tom, when you look at the jobs report that we saw, too hot to handle? What really stands out to you from this report?
I think number one is the unemployment number dropping, which happens to be somewhat seasonal, but it's still a really good sign based on where things were trending over the past couple months. And then secondarily, the fact that we added 199,000 jobs is fantastic, but of the 199, I believe 150 were non-government, which is a really good number to see that over 75% of the jobs added were non-government. So it's a really good sign. And now, here's just hoping that not only do they not raise rates, that they don't not lower rates, that they don't raise them as well. So I think we're going to be okay.
Yeah. And in terms of the hourly earnings, good morning, it's Manis here alongside. Average hourly earnings coming in quite nicely, plus 0.4% month on month, year on year, takes you to 4%. So there's no sign of the steam coming out of that engine at the moment. And this is what markets are going to focus on, isn't it? Which is there's no collapse. This is a nice soft landing, and earnings are strong.
Well, I think that what people are scared about is it's not a landing at all. And I think it's the craziest market I've ever seen, craziest economy I've ever seen. The stock market continues to go up, earnings are positive, unemployment's low.
We're certainly not laying the groundwork for a hard landing. I mean, is it that's the whole point, and that's what the bond market rallied furiously on, which was some kind of a crack in the dam. So,
correct.
What is no landing? Because no landing doesn't get me 200 basis points of cuts from the Fed next year, does it?
No, but if they don't think it's landing at all, it might get you another 25 or 50 basis point increase. So you don't want that either. And I think hopefully we're at a point now where we say, let's let this thing ride a little bit. And I don't think we'll get the cuts, and I don't think we'll get the increase. And so we'll just be flat and see what happens. What people don't realize, sometimes the economists, definitely Main Street, is that the economy is so much different than we've ever had it in the history of this country. And what I mean by that is, number one, there's more startups than ever before. So Google lays off people. Small companies are gobbling these people up. That didn't exist. There wasn't this startup culture that people could go find other jobs. So there's just more companies that exist for people to go work at. Number two, because of technology, the skills are more transferable. 50 years ago, if I was a General Motors or a Ford or a Chrysler car person, that was all I could do. Today, because of technology and transferable skills, you're not stuck in one industry vertical for your whole career. You can move into other areas. And so those are the types of things that have made this jobs recovery and this jobs economy so much different than any other time in American history.
And Tom, to see some of these rate cuts play out, though, does something need to break? I'm just looking at the unemployment rate, extremely low at 3.7%. I had seen expectations maybe for that to cross the 4% threshold.
Yeah, I think what we're seeing is it's not gonna, the only way, if the Fed really believes that the only way to curb inflation and get it down to 2% is to have massive layoffs, I think which would be destructive to the overall economy, not helpful, but destructive, would be to raise rates, 150 basis points over the next 3, 4, 5, 6 quarters. And I don't think that's going to happen because right now what we're seeing is companies can survive and operate with relatively normal interest rates. And what we had was just too long of an explosion of growth due to 0% interest rates and no repercussions. And that's the challenge is when you can open up a business as a venture capital firm or you can finance one as a private equity firm and have almost no risk of loss, that creates a net for everybody that's just not fair. It's not safe. It's not normal. Now what we're seeing is with normalized interest rates as we had throughout the history of this country, the economy can still survive, and that's a positive thing for society.
One of the biggest debates that we have been having during this massive rally in the bond market and sort of explosion in equity markets higher was that we were going to face some kind of a debt cliff, a sort of a refinancing cliff in theory. Do you believe that that's part of the reason why we're still sustaining ourselves, that cliff is just not materializing?
Yeah, I think it's a matter of time. I think what we've got is that there's more equity in people's homes than we've ever had before. And at the same time, the rate on borrowing money is increased. And so what we've seen is people have the ability to borrow more, and we're seeing consumer debt increase. We just haven't seen it hit the wall yet. And I think that the biggest change I've seen in consumer spending and debt versus ever before is that people used to borrow and have home equity lines or whatever it was, but they were also saving for rainy day. And now what it seems like is no matter how much money people have, the saving for rainy days gone out the window because there's this sense of the government will step in, I'm not going to get kicked out of my house. And there's an overall cultural shift that's existed. And I don't think it's going to happen in 2024, but eventually the rubber's going to hit the road there due to the deficit and the large amount of individual debt as well.
Yeah, we're talking to CEO of LaSalle Network, Tom Gibble. Tom, you make an interesting point because when we were talking around Black Friday and Cyber Monday sales, it seemed like the consumer was more than happy to use things like buy now, pay later, taking on credit card debt to keep buying goods. You're talking about the rubber hitting the road in 2025. How does that shake out with a labor market that you made the point to that's still strong and still has quite a number of transferable skills if people were to be laid off?
Well, I think that's exactly. I think you're going to have a big comeuppance, and it'll probably make a difference of who wins in the election in 24 and where Congress sits of what the bailout will be. So now we've had, in the past 15 years, we've had the recession and the corporate bailout. We've had the pandemic and the consumer bailout. So now we're going to look and we're going to see what's going to happen when we get if we get another recession, and how bad it gets on the homeowner side, on the residential, on the commercial real estate side, and what we see with the continuing growth of the national deficit. So I think that because we've had this expansion of companies, and to quote Tom Friedman, right, the world really is flat from a standpoint of jobs being able to be done anywhere in the world, that I think people are going to realize that they've got to work and they're going to take jobs below what they were making. Salaries are inflated right now. I don't care what anybody says. We're up 4%, wages are, and what's gone on in the past 30 months with wage increases on the hourly side and the salary is crazy to happen that fast. And it's going to come down, whether it's in 25 or 26, it's going to come back down eventually. And I think that as long as people have jobs when that happens, we'll be okay. But you will see that a recalibration on wages.
But that's interesting. So you're saying we see kind of a resetting of wages in 25, 26, so nothing in 24. Like in terms of when you're looking at the labor market, wage growth, recession risks, that's not a 24 story at all in your view?
No, I don't think it's going to be a 24 story. I think it's not going to be a 24 story for two reasons. I think number one, we've still got the infrastructure bill. And so what that means is the government's hiring people like it hired 25% of the 199 that were added in the November jobs report. And that leads to trickle-down economics to the private sector on the infrastructure package. So we've still got this infrastructure package and all those trillions being spent. So that keeps things afloat in 24. Plus, you have an election cycle year, which there's obviously incentive for that to keep the economy humming as well. So 24, I don't see being a problem whatsoever. I think that we're pushing things, we're kicking the can down the road a little bit.
I just want to come back as an intern on Wall Street where I get $120 an hour next summer. I'll just leave you with that thought. That's what they were paid in 2023. Will they be able to command that in 2024?
Interesting conversation, though. Thank you so much, Tom Gibble, again, CEO at LaSalle Network, joining us via Zoom from Chicago. Interesting, still talking about this jobs number, talking about wage growth. We are seeing markets continuing to trade higher right now. S&P up 20 points on the day. And with that, let's go get some company news with Bloomberg's Steve Rappaport.
Good morning, Bailey. Shares of Microsoft are up less than 1%, and that's after the company announced it would convert temp workers to unionized employees. We get more on that from Bloomberg's Denise Pellegrini.
Well, Steve, it's probably safe to say it's fair to view this as a big victory for organized labor in a big tech world that typically shuns unions. Microsoft in January agreed for the first time to collective bargaining with ZeniMax Workers United, an affiliate of the Communications Workers of America. ZeniMax represents about 300 quality assurance workers at a Microsoft-owned video game studio, and the CWA says contract talks have been underway since April. Microsoft, for its part, says it looks forward to continuing good faith negotiations. Steve?
Denise, sticking with Microsoft, antitrust regulators in the UK are considering whether to investigate the company's partnership with OpenAI. The Competition and Markets Authority approved Microsoft's acquisition of Activision Blizzard 2 months ago. Honeywell International's stock is lower after it announced a big purchase. Bloomberg's Joe Easton reports from London.
Honeywell buying the security division of Carriers. Now, this is a $5 billion deal. It is the electronics locks business of Carriers. Honeywell has a market cap around $130 billion itself, so it won't be a huge company to digest for them.
And that's Bloomberg's Joe Easton. A word of caution for Novo Nordisk shareholders. Analysts at Jefferies Financial Group predict the stock will underperform next year as hype for its weight loss drug fades and competition from rivals like Eli Lilly heats up. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets right after this.